City, I'm Shauna Smith. Along investors make smarter decisions for their portfolios. We're tracking early session volume while bringing you today's top market themes and elevating Yahoo Finance's most popular newsletter.
We got a lot of ground to cover this Tuesday morning. Stock futures edging lower right now as investors take in the newest announcement from AI darling Nvidia and awaits the latest interest rate decision from the Federal Reserve to come Wednesday. That meeting 2 days, though, begins today. All eyes on the central bank's dot plot for further insight into the number of rate cuts expected in 2024.
And big news out today, the era of negative interest rates is over, at least for now. The Bank of Japan raising its key rate for the first time in 17 years. The Japanese yen sliding against the dollar. We're also seeing some movement to the downside in the bond market as well. So let's get right to it. The three things that you need to know, your roadmap for the trading day. Yahoo Finance's Dan Halley, Josh Schaefer, and Akiko Fujita have more.
Nvidia is looking to hold on to its lead in the AI race. CEO Jensen Huang took the wraps off the company's new Blackwell GPU architecture here in San Jose during its GTC conference yesterday. Huang also took the wraps off of the company's new GB200 processor, something Huang says is the world's most powerful chip.
And stock futures edging lower this morning as the Federal Reserve kicks off its two-day policy meeting. With inflation still running well above the Fed's 2% target, the Fed is not expected to cut interest rates in March when it ends its two-day meeting on Wednesday. Investors will, however, be eager to digest the Fed's latest dot plot, which will signal whether the central bank officials still agree that 3 interest rate cuts are likely in 2024.
And the Bank of Japan raising borrowing costs for the first time in 17 years. Japan ending 8 years of negative interest rates by setting a new policy rate between 0 and 0.1%. The Japanese yen sliding against the dollar on the news this morning as global markets brace for the ripple effects from the BOJ's tightening.
Our top story this morning, Nvidia's big AI conference, shares of the AI darling ticking lower after CEO Jensen Huang unveiled the company's hotly anticipated next generation Blackwell chip alongside a number of other announcements. For those announcements, we go to Yahoo Finance's Dan Halley here with the 3 biggest takeaways from the opening remarks from the CEO of Nvidia. Hey, Dan.
Yeah, Brad, you could probably describe yesterday's conference where Huang took the stage at the SAP Center in San Jose, as a victory lap for the company. The people were packed up to the rafters. I have some video that we'll have later this week, but it's absolutely incredible to see how many people were in there just to hear everything that he had to say. And he basically kicked things off from when Nvidia started investing in AI to today. So the 3 biggest things that he announced are the new Blackwell GPU architecture. This is basically the successor to its H100 and H200 chips. That's the Hopper architecture. So going forward, this is what AI chips are going to be based on at Nvidia. They also announced the new GB200 super chip. That's the Grace Blackwell is what GB stands for. Grace is their CPU. Blackwell is a GPU. And basically, it takes 2 GPUs and mates them together with a CPU to form what Huang says is the world's most powerful chip at the moment. And so that chip is going to be running different AI inferencing and training programs that companies want to get access to. And then finally, he announced at the end of the show what they call Groot, which is basically a new type of AI architecture, of a foundation model for humanoid like robots. So you can think not exactly Terminator or Bender from Futurama, but the early stages of getting some kind of humanoid-like robot up and running. And so it would be able to help with motor functions as well as natural language understanding. And that, he said, is something that the company sees as a very long-term bet for them. So he was on stage. There were some digital representations of some current humanoid-like robots that are being developed right now that NVIDIA is actually working with. So those are really the 3 key takeaways, I think, from the event yesterday.
All right, Hallie, thanks so much for bringing us the latest there from NVIDIA. We want to continue talking about what was unveiled yesterday because NVIDIA, like Dan was just saying, unveiling the world's most powerful AI chip at its big event this week, a move that could further solidify the chipmaker's dominance. CEO Jensen Huang also touting partnerships with companies like Dell, SAP, Synopsys, Ansys, and Cadence Design Systems, sending shares of those stocks higher in pre-market trading. We want to bring in Bob O'Donnell. He's Technalysis Research President and Chief Analyst. Bob, it's great to have you here, and I know you're joining us live from the conference. I believe just your reaction to what we heard yesterday from Jensen Huang and whether or not those announcements lived up to the very high expectations.
Well, first, to jump on Dan's comments as well, I mean, it was like a rock concert. It was unbelievable just to see the level of excitement there. And I went to GTCs a long time ago. And let me tell you, the mood was not the same as it was yesterday. So clearly they do have this incredible momentum. And yeah, I do think they delivered on what they promised. And I'll even add one extra thing to what Dan had brought up in terms of important things. Not entirely sure how the market's reacting. Maybe some of this was already baked in. But look, at the end of the day, this next generation Blackwell architecture sets the stage for them to stay ahead of the competition. And arguably, it was the first one designed and released in the generative AI era. While previous NVIDIA chips, of course, are being used for generative AI, they were actually built prior to the explosion of all this. This one kind of was built in that time era. The other big takeaway, and this is a big strategic move long-term for NVIDIA, like Dan mentioned for Groot, is software in general. They unveiled something called NIMS, NVIDIA Inference Microservices. Very technical thing, but it's these little containerized applets that companies can use to put together Gen AI applications. And importantly, of course, it's based on NVIDIA's CUDA, which is this software layer that's been the sticky part of this whole system. So the thing about NIMS is that companies can make the process of building Gen AI apps, which, by the way, is still really hard, much easier, thereby allowing more companies to do this. And by the way, along the way, NVIDIA becomes more of a software company, in addition to being a chip company with new revenue sources from that software.
And so, Bob, how does NVIDIA add on to what is already seeming or feeling like these peak levels of generative AI mentions? Second highest number, by the way, according to FactSet data, of S&P 500 companies citing AI on earnings calls over the past 10 years. So how much more difficult does it become for not just NVIDIA, but for the rest of the potential benefactors in this environment to now show Wall Street, to show investors that it can actually deliver on some of these promises?
Well, look, Brian, that's a great question. And that's why I mentioned this NIM software and another concept they called AI Foundry. And the AI Foundry is this idea of being able to build for people like a foundry, a chip foundry, but this is a software foundry, these applications. Because, yeah, look, the excitement's been out there. Now it's about, hey, we need to deliver this. And we've seen the potential, we've seen proof of concepts, but how do we get regular companies to be able to build this stuff? They don't have all the data scientists they need to be able to pull some of this stuff off. So how do we make the process easier? And that is what a lot of this software work that NVIDIA is doing is working on. And, and on the hardware side, the other thing to remember, look, when you're 90% of the market and you're way ahead of everybody, you're basically competing with yourself. That's what they're doing right now, is they're competing with themselves, pushing themselves forward. And, I think they did a good job with Blackwell. There's a lot of interesting things about the architecture that they've done, like I said, that are kind of built in this era of Gen AI applications. And they made some tweaks to allow performance improvements at a big level, and also important energy efficiency improvements, which also is going to help them in the long run.
Bob, how critical is it for other tech players when you see the reaction in a name like Dell here this morning after Jensen Huang touted the fact that he said, quote, nobody is better at building end-to-end systems of very large scale for the enterprise than Dell. We're also seeing reaction in SAP this morning. How critical is it for other tech players to be using NVIDIA's platform at this stage in the AI cycle?
Well, I think they all think it's incredibly valuable and important. I mean, I have never seen more partner announcements at an event, I think, in my life. I mean, everybody and their brother like wanted to be associated with NVIDIA. And that's what we saw. We saw all the major cloud providers, all the server makers, Dell, of course, being called out, but there's also HPE, there's Lenovo, there's Supermicro, there's these other companies who are also going to be building stuff with these parts, all these software companies, Ansys, Cadence, all kinds of big companies who are building software based on this because they see where the market is going. They see, in fact, that NVIDIA is in the lead. So, of course, they want to associate themselves. And that's why there was just this incredible array, as I said, of different partner announcements because they want to do that. Now, we're also going to see a lot of competitors, right? AMD is going to get in here, and this market is going to continue to grow. And even if NVIDIA loses share, which is kind of hard not to do when you have that much, the market is going to still grow so much that there's still growth opportunity for NVIDIA. I don't know why the market's reacting the way it is now. Like I said, hard to predict under that particular detail, but in the long run, I think they've positioned themselves very nicely.
Hey, Bob, just lastly, while we have you here, I mean, there's a lot of focus on what the growth looks like for NVIDIA, especially outside of the U.S. as well. Are there any clear answers that are coming forth from this conference about how this company is going to service into China, where there's already even more between the U.S. and China of the kind of tit for tat that's continuing to play out, which puts a bit of a dampener on the opportunities in that region?
No, it absolutely does, Brad. And I don't see an easy answer. I mean, this is a difficult problem that I think all tech industries all tech companies are going to face. People like NVIDIA and AMD and Qualcomm and Intel in particular producing, very highly performant chips. They're the ones who are obviously being restricted more already. And so, yes, that is a bit of a damper on the business. So they are all working on developing chips specifically for the China market that can, still provide some capabilities. China says they want to do all their own, but they are years and years behind the most advanced technologies. So, it's going to be a very interesting situation to watch. Again, I think longer term, what NVIDIA tried to do at this particular show is show to the world, hey, we're going to build these amazing chips and we're going to make them better and better. But hey, check out this software stuff because we're going to be doing it too. We're going to start charging on a per hour basis, of per GPU per hour to use some of these services. Again, that's really interesting. Revenue there, obviously almost nothing right now, but what's the opportunity?
All right, well, Jensen Huang, CEO of NVIDIA, certainly resembling something of the greatest showman right now as this event continues to roll on. Our own Dan Halley out there. Bob, thank you so much for taking the time as well. Bob O'Donnell, Technalysis Research President and Chief Analyst. Definitely. Well, the Bank of Japan, the BOJ, is raising interest rates for the first time in 17 years today, making it the last major central bank to exit the world's negative rate policy. The country is the top holder of U.S. sovereign debt, and as yields are going up, what does this mean for the global bond market? To help break down how investors should be looking at this policy change, we've got Yahoo Finance's very own Akiko Fujita here with us. Hey, Akiko.
Good morning to you, Brad. You're certainly right. This is truly the end of an era when you consider the Bank of Japan, as you said, the major central bank or the last of the major central banks to exit a policy that was largely seen as extreme and risky in the aftermath of the global financial crisis. At its peak, you had the European Central Bank as well as central banks in Denmark, Switzerland, and Sweden all setting their interest rates below zero. And now that Japan's ended the longest experiment, the question is going to become, number one, how effective was this? But also, what does it mean for global markets? We should mention the BOJ governor largely messaged this move, but we did see that dollar-yen cross push lower with the dollar, or yen, I should say, trading about 150 to the dollar there. It's certainly going to be interesting for U.S. investors to be watching here the impact this is going to have on bond markets outside of Japan, particularly treasuries. This 8-year experiment left more than $4 trillion in funds for higher yield outside of Japan. Japan, as you mentioned, the largest buyer of U.S. debt. We're talking about $1.1 trillion here. And the question is going to be how quickly that money will return to Japan, with yields for Japanese government bonds expected to push higher, though we should point out this yield differential between the Japanese government bonds and other bonds certainly still remains high. Now, the other thing to watch here is going to be what happens to the Nikkei. We've been talking about this a lot. The Nikkei hitting records in recent weeks here, largely driven by fundamental policy changes, but also driven by a cheaper yen, with the yen expected to push higher now. What does that mean for the foreign money continuing to flow into the Nikkei's rise here? Now, as with other central banks, the other thing to watch here is how rapidly the rates are going to rise. We heard from BOJ Governor Kazuo Ueda saying that he doesn't anticipate the accommodative financial conditions will be maintained for the time being, or he anticipates, I should say. So he doesn't expect rates to rise very quickly because when you think about it, the inflation rate in Japan is still at 2.2%. The Bank of Japan has lagged the major central banks, but we're not talking about the kind of inflation that we saw in the U.S. Now, one more thing to note here. The government did, or the BOJ did also abandon the yield curve control. That is the bond or the policy here that has kept Japanese governments largely tethered to that 0% rate. And last number to leave you here with, this really speaks to the scope of this policy that has been in place for nearly a decade now, 17 years since the hike. All combined, the Bank of Japan bought more than $6 trillion in Japanese government bonds. And guys, at a time when we're talking about the debt to GDP ratio in the U.S. and Japan, it is the highest in developing countries. 250% of GDP is what we're talking about. So really historic numbers here, but at least the end of an era with those negative interest rates policies coming to an end.
The end of an era, and also the move really creating ripples beyond Japan, noted by a number of strategists, analysts out this morning in reaction to the move here from the BOJ. All right, Akiko, thanks so much. We've got much more of your market action ahead. We're about 15 minutes until the opening bell. Taking a look at futures, you have futures pointing to the downside. Looks like markets set to open in the red. We've got more on that when we come back. A historic move by the Bank of Japan, the central bank raising its key policy rate for the first time in 17 years. The yen sliding against the dollar. You also have yields moving to the downside. Now, the Bank of Japan's action coming ahead of the Federal Reserve's decision tomorrow. We want to bring in Christy Akulian, BlackRock Senior Investment and Portfolio Solutions Strategist. Christy, it's great to have you here on set.
Thanks for having me.
So let's talk about, let's start with the news out this morning. Bank of Japan, the big headline here. In terms of what this means, ripple effects beyond Japan. Talk to us about how you're looking at this from a strategist perspective.
Yeah, so, I think that it's important that we note how momentous the moves were out of Japan that we saw this morning. I know we've talked about it a bit, but the first rate hike in 17 years, a return out of the very abnormal situation of negative interest rates and into positive interest rates, we think that that sets a really positive backdrop for Japan and Japan equities. And I think that how investors can think about that more broadly in their portfolio is just another way to maybe diversify away from some of the remarkable concentration that we see in the U.S. equity market. So we're constructive on U.S. equity markets, but we actually see a lot of opportunity for investors to add Japanese equities here as well.
And this is not significant enough to throw off, say, a Warren Buffett who's invested further into Japanese trading houses, we know, in recent years. I mean, this is, and for those who have subscribed to that same kind of Buffettology, if you will, of the markets, this is not enough to throw a wrench in that, right?
No, I think that the broader macro tailwinds that we're seeing from Japan moving out of deflation and into an inflationary regime are enough to offset some of the headwinds that we might see from a stronger yen.
Christy, this of course comes ahead of the Fed decision tomorrow. A lot of the focus is going to be on that dot plot, what exactly the economic projections are showing. What is your base case at this point? And do you think the market's a bit too optimistic about how many rates we are going to see or the degree of those rate cuts before the end of the year?
Yeah, so I mean, if we go back and even just think about how we came into this year, the market was expecting almost 7 rate cuts, and there was also a 100% chance of a cut, tomorrow in March if we went back to January. Now where we sit, there's about a 0% chance. So as you point out, we're not watching to see if the Fed is going to move. We're watching to see what the dot plots and the expectations of forward policy are going to look like. So, our view has always been that we think that there's probably going to be about 3 rate cuts this year, potentially starting in June or July. I think what we're going to get tomorrow from the Fed and what we're watching to see if Chair Powell can sort of navigate here is leaving himself some optionality. And I think the dot plot is going to show us that we're still probably going to get maybe median 3 cuts here, but I think the risk is that it moves to 2 rather than it moves to 4.
How much does that matter for the equity market?
I think that some of the reaction of that has already been priced in, since we've already seen so many of those cuts come out of the market since, just since January and year to date. But I do think that it can matter for the lower quality parts of the market. So if we look at things like small caps and we look at really highly levered companies, they've struggled a bit this year, and I think they can continue to struggle. So what we prefer instead is really staying, up in quality, up in market cap. We like something like QUAL, is the MSCI iShares Quality Factor ETF. That's performed well last year and this year, and we think it can continue to do so, especially if at the margins we start to see cuts coming out of the market rather than going into it.
Do you think that, and I was looking through your BlackRock weekly market commentary that the team puts out, and it had within there that inflation is likely to settle above the Fed's 2% target in 2025. So with that lead time, what does that spell out for consumer sentiment? What does that spell out for business confidence as well in that near-term period?
Yeah, so I think that there's a few different drivers of inflation happening. What we saw during the pandemic was obviously a supply side crunch. And so, I think that led to more temporary inflation, and the transitory that, is probably a dirty word now when we look back at it.
You've got it on a t-shirt at this point, yeah.
Exactly. I think that we see some broader mega forces happening in the economy, global economy, that can lead to some of that higher structural inflation. So things like demographic changes are things that we're focusing on for the kind of medium term. I think the more important thing for right now is that we think inflation can be a little bit volatile throughout this, throughout 2024. And so, maybe it's not just when the Fed starts cutting, but how many times this year. And again, it all kind of leads us back to this up in quality trade as being the best place to sort of camp out when there's that amount of uncertainty and volatility that we should expect.
Christy Akulian, who is the BlackRock Senior Investment and Portfolio Solutions Strategist. Thanks so much for taking the time here in studio.
Thanks so much for having me.
Absolutely. Well, investor risk appetite is at its highest in 3 years. That's according to a new Bank of America survey out today. We're joined at the desk now by Yahoo Finance's very own Josh Schaefer. Each of us is picking one chart from this B of A survey, Josh, to dive into. So let's start with you. What are you interested in here?
Brad, a really exciting chart on bond yields, right? We always want to talk about bond yields. Guys, why not? Expectations for lower bond yields falling to a 1-year low, according to Bank of America. And the reason I point this out is similar to some of the conversation you guys were just having about rates here. And we've seen basically a repricing of what we're expecting from the Fed this year down to about 3 cuts now for the year. And the largest question I think right now, though, is how long are we going to see this volatility in the rate trade? Because right now that volatility in the rate trade, when you look at some of the things that benefited from the dovishness in December, like a small caps, That's down almost 2% over the last week, while the S&P is actually up a little bit, if I was looking at my charts right earlier. So you've seen a significant lagging still from small caps compared to the S&P 500 as we've gone into this unsteady trade. One thing that was interesting, though, in that trade that Mike Wilson over at Morgan Stanley was pointing out is you've still seen large caps be able to perform here. It just hasn't necessarily been tech. You've seen a little bit of a cycle into more of a broadening out. And so that's kind of my biggest question post-Fed. Is can we still see some support here and some broadening out even if the dot plot doesn't come in that dovish? Is the trade still broadening out or is it a sell-off?
Well, and it's what it comes back to, too. And this takes us to my chart, actually, because it's a little bit more on macro as it came through via this fund manager survey. And 2/3 of the respondents here, which was interesting, saying that recession is unlikely in the next 12 months. There you're taking a look at the chart here. The recession risks dissipating, and particularly one of the things that was noted here is that the global economy will experience, well, they said it was unlikely that the global economy will experience a recession in the next 12 months. Get this, and take a look at that chart. That is the most since February of 2022. So the highest level that we've seen since 2022 of respondents saying that it is unlikely we would see a recession. So that perhaps dovetails into some of the confidence or the risk-on tenor in some of the...
Here's the question, Brad.
Yeah, sure.
Does that start coming down if we end up in a higher for longer state and we have people start talking about lagging impacts again? I'd be curious what that chart looks like in 2 months, right? Because we've had everyone talking, no recession, we're in great shape, we're in great shape.
Right.
When do some of these economists start saying, should I be worried about the labor market?
Well,
like we were worried about the labor market with high rates, right? And now we're talking higher for longer.
Right.
Does this start to come back down? Everyone's taken off their recession call in the last 6 months, it feels like. Does that start to shift back? I think will be interesting.
You would think it would, right? Because it kind of goes to the narrative that we were talking about, at least at the beginning of 2023, this expectation, Josh, like you were just saying, the higher for longer, the fact that we were in the expectations very different from the scenario that we're looking at today. But if we do see any sort of change to the dot plot, like our previous guest Christy was talking about, if we do see any sort of a risk here that maybe the Fed is only going to cut 2 times, maybe that doesn't necessarily impact equities, at least to the extent that many are fearing it would. But you would think you would get some more people, at least a handful more people, saying that the risk of recession is a little bit higher than what it is today.
Right. Someone's got to be contrarian, Sean.
Someone's got to be
Well, yeah. Well, 62% of these respondents, and it's what the respondents are saying. 62% of them saying there's a 62% probability of a soft landing here. So that is the consensus as of right now. All right,
and real quick, we're going to throw up my chart because we're going to talk about the most overcrowded trades, how people are positioning. We have seen a bit of a shift, and long Mag 7, the most overcrowded or the most crowded trade, at this point, 58% of respondents saying that. So we have seen a bit of a shift here. In terms of whether or not we're in an AI bubble, the other topic that everyone loves to debate at this point, the respondents were pretty split. 40% saying that we are in a bubble, 45% saying no. So the jury is still out on that. Time's going to tell on all of our charts.
Bitcoin was on there.
Bitcoin.
Long
right?
Bitcoin.
Sean,
Made its fifth appearance.
The headline. 10% people are long Bitcoin.
I knew
it's
Brad
first
wanted to talk
appearance in
about
the
it.
chart.
I know. All right. Well, when we do this again, my chart's going first. All right, Josh. Thanks so much. We have the opening bell coming up in just about 2 minutes. Stick with us. We'll be right back.
All right, big opening bell energy, big cosmetics week energy over at the New York Stock Exchange too. You had eyes, lips, and face elf yesterday, and today you get a little Cody ringing the opening bell there at the New York Stock Exchange. And in Midtown Manhattan, you've got Gentex Corporation. I'm just assuming that's how they walk around their offices saying it. Why not? Anyway, GNTX is the ticker symbol there. You've got some mixed activity to begin today's trading session as we're taking a look at the major averages. The Dow, by the hair of its chinny chin chin, seeing gains. We'll see if it can hold on to it. It's not how you start, it's how you finish. So we'll see what goes on there for those 30 components. S&P 500 negative though, and the Nasdaq Composite also negative. Hopefully it's able to get into positive. Anyway, we're covering the biggest market movers following the opening bell on Wall Street. Yahoo Finance's Madison Mills on the floor of the New York Stock Exchange. Lots of catalysts this morning, Maddie. The Fed kicking off, and that meeting is going to go forward. Nvidia's conference going into its second day. Help make sense of this.
Well, I thought that I would never see a Fed day where nobody here at the stock exchange talks to me about the Fed for 30 minutes, but here we are with the Nvidia conference taking up a little bit of the air in the room. But interestingly, it seems like the news about that chip that had twice the power of the previous chips offered by Nvidia kind of hitting the market like a lamb this morning. And that is perhaps because a little bit of that news was already priced in. I'm taking a look at Nvidia on the Yahoo Finance platform. It looks like it's down by about 2.5% here, still trading near the mid to top of the 52-week range though. So that's also a reminder that this is a name that's had such a huge run up. It's not too surprising to see it have a little bit of a pullback, maybe some profit taking from investors who are looking to this developers conference as a chance to make a little bit of cash. Having said that though, that is going to be dragging down the other major indices, which are also impacted by that Fed day, though we are not anticipating getting any huge headlines out of that, as is notable for Jay Powell to traditionally say that he's data dependent to hem and haw. So a little bit of a meh day heading into the trade today, you guys.
All right, Maddie, let's also take a look at crypto because Bitcoin's sinking once again today. We certainly have seen a massive pullback from the record highs that we were just setting last week. What are you hearing down there just in terms of the movement and the volatility that we have been seeing play out within the price?
This is another boon for the retail investor, right? Because that is what's driving a lot of the pricing action here. We're seeing Bitcoin having hit these record highs over and over again, starting to stall a little bit. I just want to pull up my notes here on the 50-day moving average, because that is going to be a critical level to watch when it comes to Bitcoin here. That's going to be at 56,260. That's the next floor that we are looking at for Bitcoin. Now, having said that, this is not sort of a downer for alt currencies in general, because we're seeing a lot of positive movement and sparkle in some of the altcoins. Think Doge, think Shiba Inu, any of those names that you're going to see on Wall Street Bets, on Reddit. And this is typical of what happens in a retail investor heavy asset class like Bitcoin. You see this run up in the main sort of asset, which is Bitcoin in this case. And then investors say, okay, well, where can I get in to have a little bit of an edge, get a little bit of profits? And in this case, you're seeing this run up in meme coins. You're seeing investor excitement around that opportunity to get in and get a little bit of a faster pull at cash. And that's exactly what we're seeing play out here. Now, this is really bad news for some of those spot Bitcoin ETFs. I spoke here at the stock exchange with Grayscale's head of global ETFs about their spot Bitcoin ETF, which had record-breaking outflows yesterday. And it looks like that's going to continue moving forward this week, you guys.
All right, Maddie, thanks so much. Teeing up today's trading activity and getting us started here. Appreciate it. We'll check back in later on. Time for today's stock to watch right now. Unilever shares moving higher after announcing plans to spin off its ice cream business and cut 7,500 jobs worldwide in an effort to scale back on costs. The split is expected to come by the end of the year. You're taking a look at shares. Right now, they're up by about 2.5%. I mean, of course, important to remember, this business has 5 of the top 10 selling global ice cream brands, includes Walls, Magnum, and of course, Ben and Jerry's. Exposure in both in-home and out-of-home market there.
Exactly. In terms of the street's reaction to this, they're pretty positive. Barclays was out saying that they value this portion of the business right around, see if I pull it up in my notes, right around $18 billion. So the brands are, like you were just saying, a handful of names that are very recognizable to nearly every single household across the nation. Now, when you take into account what this means in the long term for their business. We have certainly seen a shift of their business under their new CEO. We know the company had come under pressure from Nelson Peltz, who also has a board seat now on Unilever. He's been pushing for some changes here. So this move here is going to leave the company focused on just 4 businesses: beauty and well-being, personal care, home care, and also nutrition. So many analysts, at least at the first glance, are pretty encouraged by this, given the fact that the ice cream business had slower growth, also lower margins. So they're saying that this play does make sense for Unilever here in the longer term.
Yeah, the CEO is saying fewer things with better and greater impact. So that's what they're going to be prioritizing. We'll see how they continue to communicate some of the results to the street here. Coming up, we're going to be bringing you even more coverage from CERAWeek. We go back to Houston, Texas, where the stars at night are big and bright. We've got a conversation with ExxonMobil CEO Darren Woods. That's next.
I'm Julie Hyman. You're watching Yahoo Finance, and I'm here at the CERAWeek by S&P Global Conference in Houston, Texas, where a big topic of conversation, as we've been talking about, has been the energy transition. But there has been sort of a reframing of the conversation by some around the energy transition. One of those folks is Darren Woods. He is the CEO of ExxonMobil, and he's joining me right now. Thanks so much for being here.
Glad to be
appreciate
here.
it. When I say reframing the transition, it's because you, among others, have sort of said, we're going to need oil and gas for a little while here. Another comment on this front that really struck me today was from the CEO of Saudi Aramco, who said it was a fantasy that we could phase out oil and gas. And he said instead we should be investing in them. Fantasy is a pretty strong word. And I'm curious what your thinking is around that. And whether you think you've been successful in moving the conversation on this front.
So I think our emphasis has been, one, recognizing the solution set that the world's been pursuing with wind and solar and EVs is a necessary but not sufficient set of solutions, and that we've needed a much broader set of solutions to try to drive the change and the transition that everybody's hoping for. One that involves skill sets that, frankly, companies like ExxonMobil and our industry can bring to bear. And so that, with the Biden administration and the IRA, has started to open the aperture on other opportunities to reduce emissions above and beyond what wind and solar can do. So carbon capture and storage are a really important part. Hydrogen, low carbon hydrogen is an important part of that. Biofuels is an important part of decarbonizing the world and society. And so that conversation is starting to evolve, and people are becoming more accepting of that. And that's what we're focused on, is at this stage, when we have this huge challenge in front of us of decarboning the energy system, is we need more solutions, not less. And I think we're seeing that conversation happen. And because we've been so narrowly focused, the time it's going to take to achieve it has been slowed. And I think one of the reasons for what you heard with Amin is that idea that as the longer it takes to transition, the longer you're going to need traditional fuel sources.
I'm glad you brought up the IRA as well as sort of something that spurred investment here. We're obviously in a presidential election here in the United States, and former President Trump has talked about getting rid of the IRA. Obviously it's legislation, so he couldn't do it alone, but he could weaken it. And depending on what happens to Congress as well, maybe he could get more people on board. Sounds like you're a fan of the IRA. It's been helpful in some ways to your industry. So what are your thoughts on whether that could potentially be weakened?
Well, I think, in terms of the IRA, our view is if the society wants to decarbonize, the way to do that is to focus on the source of the issue, which is emissions, and to focus on, looking at carbon intensity and setting standards for carbon intensity, which the IRA did. And so it basically is technology agnostic. It says what you should focus on is achieving an outcome which is lower carbon intensity for a product. That makes us a fan, because that says it opens up the opportunity for other businesses and industries to participate to try to meet that. And that's why we're supportive of it and why we've been looking at investing in that. Ultimately, the decision as to how quickly you drive emissions reduction is going to be a function of what society wants, which will be represented through the political process and the rules that come. So if there's a change in the administration and they choose to take a different path, then we're responsive to that. But I think ultimately the world needs to decarbonize. We need to do more to reduce emissions, and I think the IRA is a good step towards that in terms of being technology agnostic, focused on reducing the emissions and lowering the carbon intensity of society, and I think that's the right approach.
So all else being equal, you would not want President Trump to try to eliminate?
I think this back and forth as one administration or one party comes into power and the other one comes back, and flip-flopping is not good for making progress in this space. It's not good for business. It's not good for society as a whole. We need consistency in this space, and so I would argue for, have the right kind of bipartisan debates, get to a solution set that people can agree on, and then implement that and sustain it consistently so that the businesses can then begin to plan around that and make the kind of investments that we need to in order to drive emissions reductions.
So the trajectory that we're on currently, where we are still seeing growth of demand for oil and gas, production of oil and gas, at the same time, as you talked about, concomitant with the growth in other types of energy sources and with carbon capture technologies. Are you confident we can stay on this trajectory and also mitigate the worst effects of climate change, some of the, sort of climate catastrophes that we've begun to see crop up over the past several years?
So I think one of the challenges is the way the problem has been stated in the past is we need to get rid of fossil fuels, natural gas, crude, and coal. And I think what we should stay focused on is we need to get rid of the emissions associated with the combustion of those things. And I believe that while there are some circumstances where you need to get rid of the products and you can't continue to combust, there'll be other circumstances where you just deal with the emissions. And so carbon capture and storage allows you to continue to use existing energy systems, but capture the emissions associated with the combustion in those energy systems. That will be a very important part of the solution. If you look at what we're trying to do in our Permian, in the unconventional business, we are actually growing production and reducing emissions, and we've got a net zero emissions plan by 2030 for our Permian production, which is actually growing over this time frame. So you can do both, but you've got to be very thoughtful about it. And I think that, again, it comes back to the focus ought to be on how best do we reduce the emissions. In some cases, it means getting rid of existing energy systems. In other cases, it means dealing with the emissions associated with those energy systems. And we should be open to either one of those. If we open our minds and stay focused on the right problem statement, I think we can make a lot of progress a lot more quickly than we have been.
2030 is not that far away.
No.
How far are you towards that goal? Because we've seen some carbon capture, both by you all and other companies, but it hasn't really scaled as of yet. So are you expecting to see a big acceleration in the next 6 years?
So in the Permian, the net zero for the Permian is the emissions associated with our production of oil and gas. And so we're on track to meet that objective. And so we're electrifying, we're putting in renewable power systems or contracting for renewable power. And so that's on track, and we're going to achieve that. Very, very confident in that. Carbon capture and storage is a brand new industry. And one of the big challenges we've had in that space is you're creating a brand new value chain with a technology that historically is used for another purpose. That's moving along, but it is going to take time. But just to give you an example of the scale that our industry can bring to this, we've got 3 contracts with an industrial gas supplier, with a steel plant, and with a fertilizer company to capture their CO2 and to store it, 5 million tons per annum. That storage, that capturing of that CO2 and storing it is the equivalent of all the electric vehicles that have been sold in the US in total. So just 3 deals at scale is equivalent to the entire electric vehicle fleet in the United States.
And when are you there? When, in other words, you signed the deal?
We signed the deal, so we're starting to build the facilities, and we will be bringing those facilities on 2025, 2026 timeframe. And then that business will continue to grow. We invested in a CO2 pipeline system that allows us to basically transport that CO2. We've got the ability to do the drilling and to manage the reservoir, and we have the technology to capture the CO2. And so we're putting together that value chain, signing deals. We've got a group that's continuing to work on additional deals, and our expectations will continue to grow and capture more and more CO2, and it'll make a big difference.
CERAWeek by S&P Global, bringing together all of the top names in oil and natural gas for the annual Global Energy Conference. And Yahoo Finance had a front row seat, bringing top commentary, including a conversation with ExxonMobil CEO Darren Woods, where he spoke with our very own Julie Hyman about the energy transition.
Our emphasis has been, one, recognizing the solution set that the world's been pursuing with wind and solar and EVs is a necessary but not sufficient set of solutions, and that we've needed a much broader set of solutions to try to drive the change and the transition that everybody's hoping for.
For much more on the energy space, we're now joined by Pavel Molchanov, Raymond James Managing Director and Equity Research Analyst. Pavel, thanks so much for taking the time here today. You just heard the commentary there from Darren Woods here. I'd love to get your perspective on what he had to say about this broader transition and what some of those takeaways that he's seeing from that seat at ExxonMobil from the CERAWeek conference.
It's factually true that fossil fuels will continue to be needed for a long time to come. I mean, no one has seriously disputed that. So when, we talk about net zero emissions by, 2050, right? That's 26 years from now, to state the obvious. And even then, by 2050, there will still be need, for some amount of fossil fuels, for example, natural gas to make chemicals, oil for aviation and the marine market. But it is a question of time, before, for example, global oil demand peaks and begins to decline. We just don't know yet, precisely what that timetable looks like.
So then, Pavel, with that in mind, what do you think this really tells us about Exxon's strategy then, given the fact that demand for oil remains high and is likely to remain high, like you were saying here, for years to come?
Well, we know that Exxon is acquiring Pioneer Natural Resources. It was one of the largest acquisitions in the history of the oil and gas industry. We know that Exxon is investing in some kind of renewable and energy transition initiatives, so carbon capture that you heard in the interview about. But look, as a general premise, the only oil companies today that are truly kind of needle moving in their, sustainable energy investments are in Europe. So these are going to be companies like BP, Equinor, Shell, Total, Eni. American, oil and gas companies are generally further behind in their energy transition plans, and the same thing, I would say for companies like Saudi Aramco or PetroChina or Petrobras.
Pavel, I wonder from your own modeling and your own research here into these equities, into these major oil and gas names, what timeline you're kind of annexing to some of the ambitions that they've communicated to the street?
Yeah, so net zero for just about all these players is middle of the century, right? So that's a long time from now, to say the least. It's safe to say that none of the executives who are who have made these net zero decisions in recent years will be running the companies once net zero actually gets implemented by the middle of the century, which means it will be up to the subsequent generations of management teams, to make the kind of the tougher decisions for how to reach net zero, within the next 25, 30 years.
Do you foresee a changing of the guards or a changing of the person behind the resolute desk in the White House as throwing off some of those timelines?
Well, as I mentioned, the most ambitious roadmaps for in the near term for energy transition in the oil industry are in Europe. So of course the U.S. election has no relationship to that. As far as Biden versus Trump, short answer is no. Once companies have committed to net zero, let's remember, this is not because the government is forcing them to do it, right? Nobody forced Exxon to put out a net zero target. No, even in Europe, by the way, these are not legally binding, net zero requirements for the individual companies. It's a largely matter of ESG, shareholder pressure, kind of voluntary decision making. And here's the reality: no matter how the politics goes, energy transition will continue. Yes, governments play a role; they can play a useful role or a less useful role. But for the industry, it is important to remain on this roadmap, or frankly, risk getting left behind.
Pavel, let's zoom out a little bit, talk about what's going on at a macro level, because one of the big drivers in the recent price to the upside, movement to the upside in the price of crude has been Russia's war in Ukraine. Now, there is talk, or there is, I guess, some sort of line of thinking here that we could see a cap on the move higher if we do see more Russian oil come online. What do you see this doing to the price of crude, at least in the short term?
So when Russia invaded Ukraine, just over 2 years ago, the number one question right at the outset was, would the Kremlin try to weaponize its oil industry? In other words, deliberately cut off supply as a way of hurting the global economy. And the Kremlin tried playing that game with natural gas, but not with oil. So that's why when oil prices ran up in the middle of 22, they came down pretty quickly once people realized Russian oil is continuing to flow. In recent weeks, however, we have seen the war quite literally begin to have an effect on Russian supply, because Ukraine has become skilled at using drones to physically attack Russian oil infrastructure. Now, it's not the oil fields themselves. Those are too far away in Siberia, but the refineries across Russia, the European portion of Russia that are, processing Russian crude, have been attacked numerous times by Ukrainian drones in recent weeks, and that has pushed up the price of oil, and in particularly the price of refined products, so gasoline and so on.
Pavel Molchanov, always great to get your insight. Thanks so much for hopping on with us here this morning. Raymond James, the Managing Director and Equity Research Analyst. Thanks, Pavel. Keep right here on Yahoo Finance. Much more of your market action ahead. We'll be right back.
Good morning, everyone. I'm Brad Smith alongside Shauna Smith. We're 30 minutes into the trading session here on the day. Let's take a look at how things are shaping up right now. Stocks, they're mixed as the Federal Reserve's March meeting gets underway. All eyes are going to be on the Fed's summary of economic projections, or known in your hood as the dot plot. Investors, they're going to try and gauge the number of rate cuts that we could see this year. The S&P 500 down by about 0.2% right now.
All right, let's get to some trending tickers. First up, Supermicro Computer shares are actually plunging today, off just about 12%. Now, the news here is that the company plans to offer 2 million shares of its common stock in a public offering. Goldman Sachs is the sole underwriter of this proposed offering and is expected to have a 30-day option to purchase up to 300,000 additional shares. This coming just a day after the computer server maker was added to the S&P 500 index, and certainly we have seen massive gains in this stock since the start of the year.
We're also tracking shares of Chinese EV maker XPeng. They are down right now after the company reported better than expected fourth quarter results. The company delivered over 60,000 vehicles in the quarter. That's up from about 22,000 the year prior here. The improved sales helped offset profit margin contraction. XPeng saw that thanks to the EV pricing war, that hit on margins there.
And AstraZeneca, trending in the news today, is going to be buying a Canadian drug developer Fusion Pharmaceuticals for a deal valued at just around $2 billion. Now, it's a sign that the pharmaceutical giant is betting on next-generation cancer treatments. Shares of Fusion are also surging on the news. You can see the move to the upside there. Not a huge surprise, trading just around $21 a share.
All right. Also tracking here today, Bentley's electric vehicle lineup coming in later than anticipated. The luxury automaker delaying its timeline on an all-EV future by a few years. Yahoo Finance senior autos reporter Pras Subramanian here to tell us why this luxury automotive manufacturer is pushing it out a little bit here.
You know, they still want to hit that 2030 EV timeline, but Bentley CEO Adrian Hallmark told me and a group of journalists at a roundtable last week that some hybrids may extend beyond the company's the previous 2030 all EV deadline. They think that, you know, as EV demand cools, they want to keep some of these performance hybrids going strong here because demand is still high for these cars. Of course, we're seeing EV demand sort of reverse there. So they're pushing back the debut of their first EV to 2026 until 2025. And they want to have these EV cars out by 2030, but they just might not have fully electric portfolio just quite yet.
So, Bros, this is a setback here for the company. As you look out to what demand is going to look like here for Bentley, 2023 was a bit tough here given the obviously macroeconomic environment right now. How does it look for 2024? Are we expecting to see more of a rebound?
So I spoke to Adrian about these issues, and he said that 2023 was a bit of a dip compared to 2022 because it was such a strong year. They had so many people who were pandemic buying like crazy, and they couldn't even fulfill. They had 16,000 orders, only 15,000 slots to actually make these cars, which is a lot for a lot for a luxury automaker based in Britain. So 2023 also saw uneven performance in China and Europe. Basically, China had a bad first half, but then improved second half. Europe was the reverse: good first half, bad second half, and the U.S. has been pretty strong. So looking ahead to 2024, they expect kind of more of the same. Improvement in China, I think, was a big factor for them. That's a huge market for them with the Bentayga and cars like that. So yeah, I think that you're going to see that. Plus, personalizations, custom work is like a huge profit driver. 70% of orders had these in their cars last year, so they think that continues, and they want to keep pushing that personalization, custom work for their cars.
Interesting. All right, we'll see if I can ever become one of the Bentley potential buyers out there. Perspective and aspirational. Thank you so much, Pras. Appreciate it. Well, U.S. home building bouncing back in February. The new residential construction jumped 10.7% in February from the month prior to an annualized pace of more than 1.5 million units. That's according to the Commerce Department. While home affordability continues to be a challenge for many Americans, the expectation the Fed could cut interest rates this year is making people more optimistic that we could be in a buyer's market. So for more on the housing sector, we're joined by Jim Tobin, who is the National Association of Home Builders Chief Executive Officer and President. The NAHB has had some news of its own this week. We'll dive into that, of course, here, Jim. But what more noticeably are you seeing in this environment, and are we set up for a shift in the sentiment out there?
Good morning. Yeah, I do think we are set for a shift in sentiment. I see optimism. We were just at our our annual trade show just a couple of weeks ago, and the vibe amongst all of the attendees was optimism. I really think they are looking at 2024 as this pivot year where we come out of the high interest rate environment. Hopefully, we'll see some of those Fed rate cuts through the course of this year, but really demand starting to come back, and of course, our members are ready to respond by building more homes and apartments.
Jim, what happens if we don't get 3 rate cuts? What happens if it's 2, or God forbid, if it's 0? What then happens to home builders?
Well, we're optimistic that it's at least 2. Some people were forecasting something a little earlier in the year. We think that the rates are going to be backloaded into the second half of the year. But I think we're not anticipating that. We're really thinking that the economy is going to keep moving along at a nice pace. I know there's been some concern about a little spike in inflation, especially in the shelter inflation piece. But I think that we will continue to see rates moderate into the 6% range. And again, we're still waiting for people to get used to the new normal out here, rather than those 3 or 4% rates that we got used to over the last 4 or 5 years. So again, we're optimistic, and hopefully the Fed will see that the right thing to do is to keep moving the country forward by bringing those rates down.
Of course, this week we got the National Association of Home Builders, the builder sentiment report that came out. That came out on March 18th, and just yesterday we heard from the chief economist Robert Dietz saying, however, as home building activity picks up, builders will likely grapple with rising material prices, particularly for lumber. How apt is the consumer environment to really take on more of this pricing as new construction comes about?
Yeah, I mean, between labor and material prices, and then you have to factor in lot costs as well. I think ultimately, if demand surges and building continues to move forward, but not at the pace to meet that pent up demand, I do see some spikes in prices coming. And lumber in particular, we saw those price spikes right after the COVID lockdowns, and when home building really got going. It's just that we're not sure that the lumber companies are really getting ready for a surge in demand, that they're kind of waiting for us to get a little farther ahead. And if we do that, then I think the fear is that the lumber company is going to play catch up, which means a supply crunch and then price spikes. And of course, that just translates into higher construction costs.
Jim, I'm curious, the big headline, or one of the big headlines, I should say, within your industry over the last week has been the NAR settlement and the cap that this is placing on commission fees. I'm curious, does that have an impact on home builders, or what does that mean then for home builders going forward, just in terms of whether or not they're able potentially to save money maybe in the long run, or is there any impact?
Sure. Home builders operate very much as just a buyer or a seller. Realtors are involved in a lot of those, if not most of those transactions when buying a new home. So if commission prices come down, then of course the cost of the builder, if the builder is selling the home, they've been on the hook for that 6% to help that buyer get into the home. So I think as commissions come down, or hopefully we're priced down, I hope that we will see costs to builders come down as well, and that just translates into lower home prices for consumers. But again, we have to see how this all shakes out. But it was a big move this week with NAR's decision.
Jim, I'm curious, have you heard from any of the home builders just how they're thinking about this and how big of a boost maybe they see it potentially being to activity here in the longer run?
Yeah, at the end of the day, for the members of the National Association, it's all about home price and building an affordable home or apartment, and anything that helps make it more affordable for Americans get into homes, that's a good thing. And if commissions are part of that, that's one part of the equation. The real answer in the long term, though, is something that the president said in his State of the Union speech. We have just got to build more homes and apartments. We have got to increase supply. So for us, the ultimate panacea for the housing affordability crisis is more homes and more apartments.
Jim, look, I'm an aspirational homeowner one day. What's the hot market that you're seeing everybody flock to right now, or where we're seeing the most spikes? Just so I have some things to consider out there. I know that Redfin is saying Portland, Oregon, in their report that came out this morning, looking particularly across the home price index. I think the only thing that could get me out there is probably Bandon Dunes Golf Resort. But what are you seeing?
Actually, I've been visiting with friends in the Portland market this week, and it's true that the Portland market, very tight, needs more housing, high home prices, but yet Portland is really starting to wake up to the fact that they've got a supply and affordability problem. So yes, I think we're starting to see some activity out here on the West Coast, but I still think the hot markets are always going to be in the Southeast. Texas, moving east over into Florida and the Carolinas. They just have a low regulatory environment. They've got a very welcoming, pro-home building, pro-apartment attitude down there. And they've got the weather. Not that Portland isn't lovely this time of year, but at the end of the day, the Southeast continues to be the boom town when it comes to home building in the country.
What do you think? Where are you going?
Oh,
Portland or Southeast?
It's brick in Portland this time of the year. I'm not going out there. I got to get a stronger jacket, Jim. It's not that good.
All right, Jim, always great to talk to you. Thanks so much for joining us here on Yahoo Finance today. Jim Tobin, the National Association of Home Builders CEO and President. Thanks, Jim.
Thank you.
Well, coming up, we will sit down with former Dallas Fed President on what he thinks we are going to hear from Fed Chair Jay Powell next week and where we are in the Fed's fight against inflation. Robert Kaplan joining us right after the break. The Federal Reserve kicking off its two-day meeting today. Now, the big focus is going to be on the central bank's economic projections. Investors are right now looking for any clues on the timing of that first rate cut. Traders right now pricing in about a 55% probability that we will see that first rate cut in June. To break this all down for us and what we could expect from the Fed going forward, we want to bring in Robert Kaplan. He's the former Federal Reserve Bank of Dallas president. Thank you so much for being here.
Good to be here.
So let's talk about what we are likely going to hear or see from the Fed this week. There's been so much emphasis placed on economic projections on the dot plot, how many cuts we are going to get between now and year end. How are you looking at that?
The Fed said in December that they were penciling in 3 for this year. I still think that's a pretty decent estimate. It may slip to 2, but it'll be in the neighborhood of 2 to 3. But the most important thing that I think Jay Powell will try to do coming out of the meeting is keep his options open and keep the Fed's options open, because there's a lot of mixed data and cross currents. And so I don't think he wants to be boxed into any particular month or action, but he wants to leave the options open that if they want to act in June, they can, but also they reserve the right to kick the can a little bit beyond June.
So they've continued to talk about data dependency, and you're giving a nod to the mixed data that we are seeing right now. So where would we see more of a trend be locked in that's in line with what the Fed's targets are?
So I'm much more of a fan of what are the drivers of the data than the actual bouncing ball of the data itself.
Sure.
And the drivers, the 2 or 3 drivers I'll mention. The economy remains resilient. However, and the job market remains very strong. There's been a little bit of increase in labor supply, which is helpful to the Fed, and that's why the unemployment rate ticked up. But the truth is there's still very strong demand for labor, and maybe productivity is improving a little bit. The big cross current that I think the Fed is dealing with, and they may or may not want to acknowledge, is fiscal spending. We ran a 15% deficit as a percentage of GDP in 2020. We ran another close to 15% in 21. That was due to ARPA. But that ARPA money actually is still not been fully spent. And then you've got the Inflation Reduction Act, and then you've got the Infrastructure Act. And so last year we ran a deficit over 7% of GDP. In 2019, the deficit was 4 and a fraction. Here's the point. Fiscal spending, I believe, is one of the big reasons the economy's been this resilient. And it's a big reason why the service sector, inflation in the service sector, is very resilient. We have an aging society. I wish we weren't aging, but we are. And workforce growth is decelerating. And so people are struggling to find workers in the service sector. And I think that makes inflation sticky. And so the Fed, looking at all these cross currents, is trying, they don't want to move prematurely. It's been a long battle in inflation. We're still at full employment. And so I think they're going to be patient, and I think they ought to be patient.
Is that enough then to maybe support the argument out there that maybe in fact inflation has stalled and will stall around these levels for a little bit?
It's possible. Now remember, there's 2 big parts of inflation, goods and services. In the goods area, not perfect, we've got pretty good disinflation in goods. It's the service sector that if there's a stall, and it all revolves around workers. Excess demand for workers, not enough workers. And we're seeing, if we see some stalling or stickiness, it'll be in the service sector. And again, if you're spending on new battery plants throughout the United States, that's the Inflation Reduction Act, new infrastructure projects, the unspent ARPA money from 2021 is still being spent, that increases demand for workers. So there's a lot of sectors in this economy that feel like they're in a recession. Anything interest rate sensitive, but this government spending on these projects, in my opinion, is creating a resilient bid for workers, and that may be creating some of the stickiness, which may create some of this stalling that you're referring to. But I don't know, and they don't know. The Fed doesn't know, and so when you don't know, turn over a few more cards and play it out. And if the unemployment rate were spiking, there'd be more urgency to act, but it's not. And so as long as employment stays strong and unemployment stays low, I think they've got the luxury of patience.
The Fed has leaned into, of course, its dual mandate, as it should. We had Fed Chair Powell, though, acknowledge that the pandemic may have changed in a sustained way how they target inflation in recent weeks. And so with that in mind, should the Fed be over-indexing or giving more weight to some data points than others as they're trying to figure out what of the past they can lean on to try and combat the same inflationary pressures?
They should be looking at data, but they should be looking at, again, fundamental drivers that explain the data. Right. Problem with data is it gets revised. It could be incorrect. It could be misleading. It's aggregated.
Which happened with the employment situation where we got those two key revisions.
I think the big fundamental drivers are we've got a decelerating, aging workforce, and we've got substantial government spending that is bidding on workers. Again, the flip is you've got a lot of immigration. Maybe some of those workers are entering the workforce. That would help. Mm-hmm. Productivity may be improving. That would help. I mean, you could grow faster with lower inflation. And so it's not clear, though. And sometimes when it's not clear, you don't want to be a slave to the data, but you want to see some discernible, sustainable trend. And so far, lately, we haven't quite seen that. And I think just take more time. Turn over a few more cards.
So what does that then tell us about the soft landing narrative? It seems like that, from the points that you're making, that at least has the highest chance of happening at this point.
I think so. So the good news is, for me, it's unlikely in the near term we're going to have a recession. The bad news is the cost of that soft landing. You've got government debt to GDP over 100%. Mm-hmm. You have government interest expense on its way to $1 trillion by next year. Rates are staying high. That really burdens business, but it really burdens the federal government when you've got $9 trillion of treasuries to sell this year. So the only thing is, everybody's obsessed, understandably, with what the Fed's going to do. The Fed will do its job. I think they should be more obsessed with the government spending and the leverage at the government level and government interest squeezing out government programs. I think that's going to be the bigger issue to deal with. And I think we do well to focus more on that issue. I think that's an issue that's going to be more thorny in the months and years ahead.
There's some overexuberance within the markets right now as it pertains to the sentiment either driven by the AI rally or driven by the level of cuts or the pacing of the cuts that we would get, as well as we saw through the B of A Global Fund Managers Survey, the sentiment the highest since January of 2022. All that considered, for this market, what should they expect of the Fed to either continue to deliver or kind of dampen down some of the expectations?
So my own view, if you look at financial markets more broadly, equity markets, if you've got growth that's sustainable, if you've got improvements in productivity, which is obviously helping, AI as part of that, right, then you could tolerate higher rates because you've got growth with it. I think the fear for the equity markets, for example, and other markets is you got slower growth and still sticky inflation. But right now, I think the stock market's responding reasonably well, not just to the Fed. They'd prefer the Fed would have been able to cut rates by now. But if the reason they're not able to cut is growth is better, then that's bolstered the stock market. My concern is this government spending will eventually need to peter out. Mm-hmm. We're going to need to get it under control. And then I think you'll see a clear picture of what's the organic strength in this economy. I think it may be slower growth than what we're seeing now. And I think that's more of a looming question for the markets.
But should this market brace itself to be upset by the Fed in the near term?
I don't think the Fed itself is going to upset them. I think the Fed will do its job. Listen, 2 years ago, I felt the Fed was dramatically out of position. Rates were too low. They were still buying bonds. It's now done a 180 and fixed that. I think the Fed is well positioned now, will do its job. I don't think the Fed by itself it's going to do what it should do. I think the market actually should be more worried about the fiscal situation and how much of this growth is organic versus artificially stimulated by government spending, which is unlikely to be sustainable. That's a bigger issue. I think not the Fed. Fed will do its job.
Robert Kaplan, former Federal Reserve Bank of Dallas president. Thank you so much for taking the time here with us in studio.
Good to talk with you.
Absolutely. We've got all your markets action straight ahead. Stay tuned. You're watching Yahoo Finance.
Retail data out of China revealing better than expected sales growth. One of the companies that has benefited from this to a certain extent has been XPeng. When you take a look at their earnings, a 53% quarter over quarter revenue increase, although off those relatively depressed levels. For more on the state of China's market right now, we want to bring CraneShares Chief Investment Officer Brendan Ahern. Brendan, it's great to talk to you here. Just put us in perspective, taking a step back and taking a look at the recent data that we've gotten out here from China. Looks like to be stepping in the right direction. How close are we just in terms of really turning a corner and seeing a stronger recovery?
Yeah, thanks for the opportunity. And certainly we're seeing China's economy come back. It's incremental, it's slow. Similar to your previous guest, Mr. Kaplan, the former Fed governor, China's been unwilling to do major fiscal stimulus because they don't want to go in further into debt. They don't want to create inflation. So they're allowing the economy to come back. And what we're seeing from the Q4 earnings thus far is restaurants and travel are where you're seeing the Chinese consumer start to spend more. And we think that will broaden out to other areas like e-commerce, which was quite strong in terms of retail sales. So China's coming back just a little bit slower than maybe investors would like.
And so for investors that are trying to position their portfolio and looking across international opportunities, how strong is China as a portfolio play? And are there specific sectors within the region that they should be focusing in on?
Yeah, I mean, we're all invested in China, either explicitly or implicitly, that you have a lot of China exposure through great U.S. multinationals, if it's Apple, Tesla, Starbucks, Boeing,
Nike.
A whole host. In terms of explicit, where we're really focused at CraneShares is on the growth segments of China's economy, that some of the underperformance of China indices is due to very high weights to financials, energy, industrials, materials, and real estate, low sectors. So at CraneShares, we want to get exposure to growth areas like domestic consumption as it happens online, clean technology, which includes electric vehicles, solar, wind, but also technology plays like semiconductors.
How much, though, is some of this optimism being offset by the weakness that we continue to see within the property sector and the fact that continues to shake the confidence, not only obviously of Chinese investors, but also just from investor interest on a global scale?
Yeah, 100%. I mean, the real estate situation in China is dual faceted. One is the falling of real estate prices has weighed on domestic consumption as urban households have 2/3 of their wealth invested in real estate. So as part of their portfolios decline in value, they've been slower in terms of consumption. The other side of the equation is distressed real estate players like the Evergrande and Country Gardens, the lack of property projects, which means less construction workers, less demand for cement and steel. And that's why real estate is receiving so much attention from the Chinese government. They won't allow a financial crisis to occur. It's not in their best interest to allow real estate unfold into a crisis, which again is why we're seeing so much policy support.
As it relates to foreign policy and international business, how much of a trading event does the general election in 2024 here in the U.S. create?
I think there's, geopolitics. Unfortunately, the politicians from both sides don't get along nearly as well as business people. Just last night, you saw Nvidia's CEO speaking to how they're actually creating chips for China's electric vehicle automakers. No different than Apple, Tesla, General Motors, ExxonMobil. Business people get along just fine, and it's unfortunate that the two sides aren't traveling more like business people are. I'm a little bit less concerned about the election because I think all the investors who are worried about it are no longer invested, and that's kind of makes me constructively bullish on the rally we've had since January.
You mentioned the U.S. multinationals earlier. What would be your top picks or plays for the rest of 2024 in China?
Well, I think self-serving and highly biased. Our flagship fund is focused. KWeb is focused on Chinese internet companies, but I think those companies, as we saw even today, look at Tencent Music Entertainment, reported very strong earnings. We had a smaller company called Tongchen Travel, reported revenue growth over 100%. Tomorrow we have Pinduoduo, Tencent, and Kuwashu reporting. So I think the Q4 earnings is showing this rebound. It's been out of sight, out of mind for investors, and that's why we're seeing this grind higher, which I'm all for. Even today's B of A fund manager, the most crowded trades, long US tech, short China. I mean, we've already started the rally, and yet these people are still shorting. So again, that grind higher makes me very constructive on the space, and it's self-serving again and highly biased that I'm more. I'm heavily invested in KWeb personally, but that is an area I really do like just because of the very, very cheap valuations, as well as the orientation to China's domestic consumption story as it comes back.
Yeah, it was interesting, as you were mentioning Tencent Music Entertainment Group and the fourth quarter paying users, the music paying users up 20.6% there, and the ARPU increased by about 20% year over year. So no doubt some good stats to come out of that report. Thank you so much for joining us here today. Brendan Ahern, who is the Crane Shares Chief Investment Officer. Appreciate it.
Thank you.
Thanks. Switching gears here, let's talk a little oil. Oil prices pulling back from a 5-month high as investor caution creeps in. Here with the latest on the slippery slope is Yahoo Finance's Inez Ferre. Hey, Inez.
Hey, Brad. Yeah, right now we are seeing oil that's inching a little bit higher right now. We're looking at oil futures that are up 0.8% for WTI, up above $83 per barrel. Brent crude is also higher. Not a lot of movement today, but adding to yesterday's 2% move. And this is actually kind of a bullish sign, because if you take a look at where we were at last week, we broke above $80 a barrel. So the fact that it is just hanging out around 83 for West Texas Intermediate, that's a little bullish. And some analysts are expecting now that you may see a pullback in the near future. But what is driving all of this? Well, let me count the ways, many ways here. But first of all, you've got the OPEC plus cuts that are still going on. You also have China data recently that came out that was positive for demand. And then you've got falling inventories in the U.S. And of course, you have those drone attacks against Russian refineries, which has been driving oil prices higher. But let me show you one other point that I want to mention, and that is energy-related stocks. Year to date, I want to pull up this chart. Take a look here. The second best performer among the sectors, up 9.4% for XLE. So there has been a rotation going into these energy-related stocks, guys.
And that's excellent breakdown and coverage as always. Thanks so much. Appreciate it.
Thank you.
Coming up, we're going to be taking a look at the state of real estate following the National Association of Realtors lawsuit settlement. We'll break it down after this. Yahoo Finance's Wealth is your guide, your group of advisors, planners, and jargon busters to help you save, build, and grow your money. How do I know if I'm saving enough for retirement? How do I know if it's right for me to go on that lavish vacation? Is it finally time to refinance my mortgage? How do I pay less in taxes? We'll get you the answers you need. Wealth, earning it, growing it, and managing it. It's more than tracking just the latest market moves. It's more than your favorite trending tickers. One does not simply build wealth without considering the entire financial landscape. It takes a community, and we've built one for you. Wealth cuts through the noise to help guide your financial decisions so that your money works for you. Wealth on Yahoo Finance premieres March 25th. The National Association of Realtors settled landmark lawsuits, agreeing to pay $418 million in damages and amend several rules around commissions. The implications could be widespread, not only for home buyers, but also for the number of companies and businesses in the sector. Let's bring in Ryan Tomasello, who is the Managing Director and Real Estate Technology Analyst at KBW, a Stifel company, to discuss more here. Great to have you here with us. Who is the biggest beneficiary as the result of this settlement?
I mean, thankfully, consumers. We think that these changes enacted in this settlement, if it goes through, are going to stand to reshape the housing market in the greatest fashion we've seen in over 50 years. Historically, consumers have lacked a lot of transparency around the process of how commissions are set and paid, particularly home buyers. And we think that these changes ultimately bring a lot more knowledge to home buyers in their ability to negotiate and sign off on those commissions. And then at the end of the day, hopefully that reduces commissions in aggregate by as much as 30% or more, we've estimated.
Ryan, to what extent is this going to reshape the housing market? And I ask that because we were talking to Jim Tobin, he was the NAHB CEO earlier in the hour. He's talking about the impact that he sees, at least, it having for home builders here in the longer term. How do you see that ultimately potentially boosting activity here over the next several months, or once it goes into effect in the summer?
Well, the plumbing of the housing market is certainly complex, and there's a lot of different stakeholders, whether it be home builders, as you point out, mortgage companies, title companies, maybe the more obvious players like the residential brokerages, and even the real estate portals that help consumers shop for homes. And we think that this ultimately stands to impact all of those stakeholders. Our focus has predominantly been on the impact to the traditional brokerage model and how that might need to evolve to adapt to these new rules, and ultimately, support buyers in this new type of structure that brings them more transparency and hopefully more options in the types of services that they can ultimately use in the home search process. Now, for brokerages, that might entail a smaller commission pool for which they're competing around. And so that can certainly cause some disruption. And then perhaps just as interestingly, real estate portals that have historically relied more on the buy side piece of this commission pool for their revenue models. Companies like Zillow, Realtor.com, may need to reconsider their focus in the role that they play in the housing market, and potentially shift that focus more to the sell side in terms of advertising homes. For home builders, as you point out, the question becomes if this overall reduction in friction costs around one of life's biggest transactions ultimately incentivizes more housing turnover, improves affordability. And certainly at the margin, we think that's true, but that will take time. And ultimately, we think overall macro supply and demand dynamics are going to play a bigger role for those types of players. But it certainly, shows you that this has a much far-reaching impact than just the traditional, broker players in this landscape.
Is this so significant then that it would change the perhaps price range that a potential buyer is willing to take on for a home?
Well, it's a very common debate around whether or not, commissions are built into the home price, and if those decline, do home prices actually fall? There's data that supports that on both sides of that coin. My personal view has been that, as we said earlier, home prices are set by supply and demand. To the extent that, these friction costs, commissions around the transaction are lowered, perhaps that does end up reducing home prices at the margin. I think another important factor here is that, there is going to be some added friction, especially near term, for home buyers that may potentially be on the hook to cover the costs of their buyer agent's commission out of their own pocket. Now, sellers and listing agents will still have certain mechanisms to be able to reimburse the home buyer for the cost of those services. But to the extent that that does not occur on a case-by-case basis, some home buyers might need to reevaluate, whether or not they choose to work with an agent, how much they're willing to pay, the scope of services they're seeking out, a white glove service versus just a more basic type of offering, and how that ultimately plays into their own affordability equation around their home search process.
Ryan, what do you think it's going to do for employment within the sector, specifically realtors? There has been a number of projections talking about the fact that people are going to be ultimately forced to leave the industry given the fact that their incomes won't be anything like they were prior to this ruling. Do you have any idea just of what the impact is going to look like here on the employment level?
Yeah, I think if there's one thing industry folks tend to agree with most, it's that there's far too many of them, real estate agents across the country. Now, there's different estimates around how many agents there are out there, anywhere from 1.5 million to even 2 to 3 million plus by some other estimates. And a lot of those agents are more marginal, meaning approaching this business as more of a side gig, a side hustle to support other sources of income. And so, these marginal agents we think are the ones that might face a more near-term reality of whether or not they choose to stay in the industry based on the cost of doing business going forward and how that needs to evolve. Ultimately, this stands to benefit the sub-cohort of agents that are actually the full-time, highest quality agents in terms of their ability to, reckon with maybe a smaller pie of real estate commissions, but ultimately getting a bigger slice of that pie, right? Because those agents will be the ones who will be best positioned to pitch their value proposition, win more business, and ultimately benefit, despite the fact that this might cause this disruption on the commission pool.
Makes sense. All right, Ryan Tomasello, great to get your insight here. Thanks so much for taking the time to join us this morning. KBW, a Stifel company. Thanks, Ryan.
Thank you.
Well, the force is strong with Disney CEO Bob Iger's newest ally, Star Wars creator George Lucas. Lucas backing Iger in his proxy fight over board seats with Nelson Peltz. Here with the details, Yahoo Finance's Alexandra Canal. Allie.
Yeah, I love that intro, Shauna. The force seems to be with Disney CEO Bob Iger. We're almost 2 weeks out from that critical shareholder meeting, and it does seem like Disney has a lot of support. George Lucas, the latest high-profile name to come out in support of the company and its current board. He released a statement saying, in part, quote, "Creating magic is not for amateurs. When I sold Lucasfilm just over a decade ago, I was delighted to become a Disney shareholder because of my longtime admiration for its iconic brand and Bob Iger's leadership. When Bob recently returned to the company during a difficult time, I was relieved. No one knows Disney better. I remain a significant shareholder because I have full faith and confidence in the power of Disney and Bob's track record of driving long-term value." He says he has voted all of his shares for Disney's 12 directors. Now, when he did sell Lucasfilm to Disney in a deal that was valued at just over $4 billion, he acquired more than 37 million shares. According to CNBC sources, he is the largest individual shareholder at Disney and obviously such a high-profile name to boot, which I think is important here as well. And like I said, recently we've seen JP Morgan CEO Jamie Dimon come out and supported Disney and Bob Iger. We've seen proxy advisory firm Glass Lewis, very respectable name in the space. They also support Disney in the current board, the grandchildren of Roy and Walt Disney. So a lot of wind at the backs here of the Disney boardroom heading into this very critical shareholder meeting, and we'll see what comes out of that vote.
All right, do or do not. There is no try. We'll see if Lucas is successful in his bid here to get his voice heard as this proxy battle goes on. Switching gears here, though, as well. India's entertainment industry is booming right now, Allie, but U.S. media companies like Paramount, we also know Disney, finding it difficult to compete right now. So both companies recently retreating from their respective positions in the country. And tell us more, what do we need to know about this?
Yeah, so I just thought it was interesting that in 2 weeks' time, we saw both Paramount and Disney really pull back in India. In India, 1.4 billion population. It's booming when you think about the opportunity there for TV, the opportunity for digital and online. But there's a few reasons why these legacy media players are having a hard time. Number one, it's very difficult to monetize in India. The India consumer is used to really low-cost options. A lot of those streaming services are bundled with mobile providers because there's not a lot of broadband infrastructure. They also have a lot of free ad-supported services from those local providers. So there's a really low willingness to pay there on part of the consumer. So you're really up against a lot of those incumbent leaders. At the same time, we also have those domestic struggles at home. There's not a lot of opportunity to invest in some of the riskier overseas opportunities that would be India. media, because right now we have streaming that is unprofitable for the bulk of players. It requires a lot of capital investment that a lot of these domestic companies just don't have the luxury of exploring right now. So it's really comes to, if you want to be successful overseas, you need to make the content investments. And really right now, the only players that are doing that to a very successful level are Netflix and Amazon Prime Video. Netflix actually in 2024, their film and TV budget overseas is going to surpass that of their domestic investment. So they're really approaching localization very critically. And these legacy players, they just don't have the luxury of time on their side to do that. Although experts I've been speaking with said if they just are patient, you could really see a pot of gold, so they say, at the end of the tunnel. But it's just right now, there's a lot of other challenges. So it's a big timing issue, I think, for these players.
Yeah, certainly under pressure. Many of these larger legacy players, obviously under pressure to cut costs. All right, Allie, thanks so much.
Thanks.
Keep right here on Yahoo Finance. We've got much more of your market action ahead. We'll be right back.
Yahoo Finance's Wealth is your guide, your group of advisors, planners, and jargon busters to help you save, build, and grow your money. How do I know if I'm saving enough for retirement? How do I know if it's right for me to go on that lavish vacation? Is it finally time to refinance my mortgage? How do I pay less in taxes? We'll get you the answers you need. Wealth, earning it, growing it, and managing it. It's more than tracking just the latest market moves. It's more than your favorite trending tickers. One does not simply build wealth without considering the entire financial landscape. It takes a community, and we've built one for you. Wealth cuts through the noise to help guide your financial decisions so that your money works for you. Wealth on Yahoo Finance premieres March 25th.
The launch of Wealth is just under a week away here on Yahoo Finance, and leading the charge, our very own Brad Smith. So Brad, we just saw that wonderful promo. Tell us, what can we expect?
Wealth is our brand new show airing daily between 11 a.m. and 12 p.m. Eastern Time, just before lunch, dedicated to personal finance so you can snack on a few of the tidbits that we have to offer during the show. We want to help our viewers think about their financial situation holistically and have the best resources for building their financial footprint. So it's a major collaborative effort here, both with our teams at Yahoo Finance and some top names in personal finance outside of our doors. The first block of the show every day, it's just going to be called My Money. We're talking about you out there. We'll bring viewers the biggest news story of the day in the context of what it means for your money. And next week, we're going to focus, will Oh, yeah, tax season. Everybody's talking about it right now. Because all of your hyper-organized Type A friends have already filled out their forms and maybe even got some money back in their pockets already. But we're going to help you figure out, and those of you who haven't filed yet, give you some helpful tips and tricks here. So tune in for the premiere of Wealth, 11 a.m. Eastern Time, Monday, March 25th. If your Bitcoin went up, what now? If that's your question, we've got some tips for you. If you updated your home to optimize energy efficiency, we've got some tips for you. Is your child annoying you? Well, get paid for it by Uncle Sam. We've got some tips for you.
You gotta let me know that tip.
Yeah?
Yeah.
You got good
are
kids, though. You got a future
they're
NBA
not
star in
annoying.
your house.
You know, you never know.
Yeah.
Shouldn't say annoying, but I'm always down to save money, so I'm gonna be looking, watching for any of those tips. All right, let's do a quick check of the markets here before we let you go. It's a mixed picture. The Dow still up in the green, up about 150 points. Akiko and Rochelle have you for the next hour. We'll see you tomorrow.
Welcome to Yahoo Finance Live. It is 11 a.m. on the East Coast, 8 a.m. on the West. I'm Akiko Fujita, and here's what I'm watching this hour. AI darling Nvidia unveiling what's in store for the company at its annual developer conference. With Nvidia moving full steam ahead in the AI race, where does this leave its competitors? We're going to be discussing. Investors also focusing in on the Fed, the crucial Federal Reserve policy meeting to indicate clues on potential rate cuts this year. More ahead on where expectations are set. Meanwhile, housing starts seeing a rebound in February, notching the largest gain in 9 months. Could this signal a light at the end of the tunnel for the housing market? We'll discuss later this hour. First, though, let's take a look at markets, where things are trading. Right now, we are 90 minutes into the trading day. A bit of a split picture emerging here. We've got the Dow up 141 points, the S&P 500 down 5, and the Nasdaq down 81. We've been watching those semiconductor shares very closely on the back of the Nvidia announcement yesterday. Nvidia, yes, down about 2% here, as are their competitors. Intel down about 2.6. AMD taking the biggest hit so far, down about 6.5% on the day so far. Let's take a look at where the Treasury markets are right now. As we said, we are watching very closely that Fed meeting, FOMC kicking off that meeting, a policy meeting today. The 10-year yield down at 4.3% and the 30-year yield at 4.44. Well, the Federal Reserve's March meeting is underway. While markets are expecting the rates to remain unchanged, all eyes will be on the updated dot plot. Joining us now is our very own Jen Schomburger. Jen, what specifically are you going to be looking for?
Hey there, Kiko. That's right. All eyes on whether the Fed still sees 3 rate cuts this year or whether officials could scale that projection back based on hotter inflation readings in the first 2 months of this year. It only takes 2 officials to pencil in 2 rate cuts for the median to change to 2 rate cuts from 3. And while the first 2 months of this year saw hotter inflation data, some officials hadn't indicated that they were swayed to change their forecast. Case in point, Cleveland Fed President Loretta Mester told me last month in an interview she was sticking with her forecast for 3 cuts on the back of the latest reading on the Fed's favored inflation gauge, PCE. Of course, she reserved the right to change that forecast before this meeting. Now, if officials don't think that the latest inflation readings change the overall picture that much, it might argue for leaving estimates where they are. Officials have warned that it would be quote unquote bumpy, and they probably have some vindication on taking a cautious approach given the hotter data that we've seen. So these bumps in the road may be built into their previous forecast already. That said, it's always possible that they feel that there's a risk that inflation is stalling here. Of course, Akiko, the other major nugget that markets are watching for tomorrow is when the Fed will finally begin lowering rates. And for that, all eyes will be on what Fed Chair Powell says during his press conference tomorrow. Back to you.
Yeah, Jen, on that point, June becoming increasingly in focus there, but what factors are likely to affect the timing of that rate cut?
Yeah, so I think the key question that we all want answers to from Powell is he told Senate lawmakers 2 weeks ago that he's not far from gaining the confidence necessary to begin cutting rates, which points to about 2 more months of data, which would put us in June. So that was keeping June on the table. The question is, that was before the hot CPI reading. Does the chair still stand by that? And if that's the case, on the flip side, what about the labor market, right? Because the Fed has said there's 2 sides here now that they're looking at. It's not just inflation. And we saw the unemployment rate back up to 3.9% in the last employment report. If that goes over 4%, you have to wonder whether that could also serve as a trigger for the Fed to begin cutting. This Fed really wants to engineer a soft landing. They want to keep people in their jobs. So 2 major factors to watch on the potential timing for this rate cut.
Okay, Jen, and I know you'll be all over that tomorrow. Jen Schomburger bringing us the very latest out of the FOMC. Well, big news out of Nvidia's GTC conference in San Jose. CEO Jensen Huang unveiling the company's next generation Blackwell AI chip, as well as new partnerships with software giants. And news it is bringing its Omniverse enterprise technology to Apple's Vision Pro headset. Joining us now on all this news, someone who attended the keynote. There you go. You got that selfie, Ray. Ray Wang is Constellation Research founder and principal analyst. Always got to get that selfie, Ray. Look, this is a stock. When we're talking about Nvidia, that is up about 75% year to date. We're seeing it down today about 2%. Is that just a matter of a little profit taking on the back or sell the news situation?
Kiko, you're definitely right. They are taking some profit taking, some money off the table. I think a lot of the news was being hyped up all the way into the conference, and I think that's where the stock price was there. But I think we learned a lot of things at the conference, and I think the most important piece is that NVIDIA is no longer just a chip company. If you look at all their extensions, they're focused on the next layer, which is really that getting that chip extended out into the ecosystem, and then of course focusing on software, which is really important for them going forward.
Yeah, we'll talk about that software part in just a minute, but this is a stock that still largely trades on that potential, or not even potential, just the demand coming through from their GPUs. The Blackwell chip here, B200 yesterday, that was unveiled, largely expected, but give me your first impression here about how this elevates NVIDIA's offering and really what this means for AI overall.
Well, they did three things that were very important. One, they had backward compatibility, which means if you have your old H100 chip, you can swap it out onto Blackwell. The second thing they did was they built a Lego type architecture that says you can tie all these GPUs together. And so it's almost like, we can turn like 10 GPUs into one big giant GPU. You can take 1,000 GPUs, turn it into one big giant GPU and pull those resources. And then I think the third thing we learned is this Blackwell platform actually achieves what we call Jensen's law, not Moore's law anymore, the ability to double 1,000 times compute every 8 years. That's actually an incredible thing when you think about what's required to take AI to the next level.
Yeah, I mean, it's so hard I was trying to wrap my head around what exactly that means today, Ray, given how far we've already come, right? How does this stack up against the competition? Yes, NVIDIA is still far out ahead, but AMD as well as Intel really trying at least to make inroads here.
So there are a couple things happening. I mean, if you look at the chip making ecosystem, there were some partnerships that were announced with Cadence, Ansys, Synopsys. So how you layer the chips, how you put the chips together, how you design them, and of course, how you manufacture the chips with TSMC. They're taking advantage of TMC's 3-nanometer technology, and more importantly, the ability to actually bring these chips together and package them in the right way. These are some of the most advanced chip making technologies that are out there, and there's nothing like it to be seen. And so the question is whether AMD or Intel or other chip manufacturers can catch up, or will people come up with an alternative to GPUs to be able to solve the same set of problems? I think the latter is what we're going to be looking for to say, is there something that will challenge the dominance of the GPU, and will it come in a different package?
You talk about the software part of it. I mean, this is NVIDIA sort of hinting at investors. We're not just about chip making here. We did see them launch a cloud service for researchers to be able to test out NVIDIA's quantum computing software. In the grand scheme of things, how big of a revenue driver is the software side likely to be for NVIDIA?
In the long term, the software side will probably be bigger than the chip part of the business. But when I mean long term, think 5 to 7 years out. When the creation of the internet, right, it was out there. I mean, we all thought the infrastructure companies were going to win, right? We're like, AOL, they're going to be up there, right? You're talking about all these other companies, like, hey, what's going to happen with Verizon and the telco business? But it turned out companies that actually built business models on the internet as a distribution channel, they're the ones that actually succeeded. It's kind of like the story that people talk about in the refrigeration business when people were building out refrigerators. It's like refrigerator manufacturers are going to be the top companies, but the company that won out was Coca-Cola. So it's companies that can actually build software on top of these new ecosystems. These are the ones that can actually build and make AI come to life.
Yeah, long term then, certainly something investors are going to be focused on. Going back to, Ray, the Blackwell platform here, the Hopper line, which is the one that preceded it, we're talking about $30,000 to $40,000 per chip. What's the pricing that you're looking at for Blackwell specifically, where you think it would allow NVIDIA to maintain at least the revenue momentum that we have seen?
Well, they haven't announced pricing, but I think most people expect it to be slightly more expensive than the existing chipsets, and because of the modularity and because of the reverse compatibility that's there. So there hasn't been a lot of information about the pricing capabilities of what they're doing, but I think the important piece is just to understand that the architecture is backward compatible, which means people will keep their H100 chips and then they'll upgrade to Blackwell or different components of Blackwell. You could see all the different combinations that you could do to combine what was happening on a Hopper chip and a Blackwell platform, and that was really the idea to say, this is not a one-way street. It actually works back both ways, and you can actually connect existing legacy architecture with this, and all the software will work the same in CUDA as well.
Ray Wang, Constellation Research founder and principal analyst. Always good to have you on the show. Thanks so much for joining us today.
Thank you, Kiko.
U.S. home building is bouncing back. Housing starts rebounding more than expected in February. We're going to tell you what this signals for housing affordability on the other side of the break. We'll be right back.
Yahoo Finance's Wealth is your guide, your group of advisors, planners, and jargon busters to help you save, build, and grow your money. How do I know if I'm saving enough for retirement? How do I know if it's right for me to go on that lavish vacation? Is it finally time to refinance my mortgage? How do I pay less in taxes? We'll get you the answers you need. Wealth, earning it, growing it, and managing it. It's more than tracking just the latest market moves. It's more than your favorite trending tickers. One does not simply build wealth without considering the entire financial landscape. It takes a community, and we've built one for you. Wealth cuts through the noise to help guide your financial decisions so that your money works for you. Wealth on Yahoo Finance premieres March 25th.
Housing starts rebounded in February from weather-related weakness at the start of the year. Yahoo Finance's very own Danny Romero has more on the housing market's recovery. Danny.
Akiko, what a turnaround story for the housing starts in February. Both single-family and multifamily housing starts jumped 10.7% last month, and that was the strongest monthly gain since May of last year. And this strong gain actually came from the single-family start home side, which is up 35% from a year ago, signaling that building conditions were good in February. Also, it shows that builders remain optimistic about the spring selling season. Now, multifamily is a little bit of a different story there. Starts for those types of homes are down 34% from a year ago. But also, real estate is very regional. So regionally, the Midwest and the South are really showing some strength, while in the Northeast and the West are really showing some weakness on that side. Bottom line, the new home market is still outperforming the existing home sales side. And builders are benefiting from this dynamic. One of their major advantages is that they're offering these incentives like mortgage rate buydowns, which is when the builder upfronts the cost to lower the rate on the loan. That has been a big seller when trying to attract buyers into that type of market. But the rebound in February that we're seeing in these housing starts and permits really signals that the housing market is healing as mortgage rates are softening. Akiko.
Okay, let's hope that momentum continues. Danny Romero, thanks so much for bringing us that story. Well, a $418 million settlement by the National Association of Realtors is expected to usher in sweeping reforms to the real estate market. The settlement came after a federal judge ruled that an existing rule requiring compensation to a buyer's agent artificially inflated housing fees. To discuss the implications for buyers and sellers, let's bring in Bill Pulte. He's Pulte Capital CEO, and Jeff Taylor, Emphasis Digital Risk founder and Mortgage Bankers Association. Gentlemen, good to have both of you on today. Bill, let me start with you first by talking about, just sort of put this in context for us. I mean, we keep hearing these sweeping reforms likely to happen. This is a significant shift within the real estate market. Put it in context for us.
Well, the reality is a home is made up of obviously lumber and drywall and roofing and all kinds of materials and stuff. A big part of it, too, is fees, taxes, title insurance, mortgage insurance, to the extent that one has all of those things. And then another thing is the realtor fees. Now, what's so interesting about this landmark thing is that now basically the 6%, in my opinion, is really up for grabs. And you're going to see people become very creative. You're going to see companies become very creative as a way towards being more competitive. And I think in an inflationary environment, all creativeness, in my opinion, is welcome. And I think that this is potentially very good for consumers.
Well, what kind of creativity are we talking about, Bill?
I think, you could see potentially people reduce their commissions. You could also see, I think, some creative thinking like the builders have done, where they've gone in, as you just mentioned, or your colleague just mentioned, the builders have gone in and bought down mortgage rates as a means of making their homes, meaning new homes, more attractive for home buyers. I think you could also see where you have potentially realtors being incentivized by some of the big builders. I think it's a very, obviously this is kind of a biased statement from my perspective, but it's a very bullish time, I think, because the big builders are taking market share from smaller builders all across the country.
Jeff, to what extent do you think this opens up the market? I mean, I will admit that I do follow quite a lot of real estate agents online. So many of them already taking to social media to say, look, we will meet you where you want to be, especially for sellers who are concerned that the cost may come down on their end or come up on their end.
Yeah, so under Digital Risk, what we do is we help lenders make sure that they're providing quality mortgage loans. As an MBA board member, also very responsible for making sure the housing market functions correctly. And this has the potential to be, as I was saying, a little bit of a game changer. There's always been this perception that it's 3% and 3%, 6% or 5%, depending upon where you are. But now, as you present that contract, look, theoretically, the seller agent could say, hey, we're going to charge 3%, but we're not going to provide anything for the buyer on that 3%. How is that going to affect that behavior? That could change a lot going forward. I think in a lot of other industries, as far as commissions, have always been negotiable. In housing, in real estate commissions, they've been negotiable too. But I would tell you, of all, if I look at money management and other industries, this has been sort of the, hey, it's 6% coming out of the gates that we've had for many years. So I think to the point of getting more creative, trying to say, hey, how much am I really going to have to pay in commissions? I think that dialogue is going to be happening a lot more at the signing of a listing agency, right? At the signing of a listing right now than it has historically. And once that conversation opens up, and it's no longer, this is just the way that it's been for 40 years, and here's the way we're entering our transaction, you're going to see a lot of other potential ways for people trying to get that overall fee down on both sides, I would imagine.
Jeff, to what extent do you think that reduces the rate on the seller side? I mean, it's been at 6%, as you said. The argument has always been this is just the way it is. How does that come down moving forward?
So look, if I'm the seller right now and I'm trying to get a listing, and I just said, okay, it's 6%, and it says, okay, but I'm plotting my listing agent, and I say, wait, do I have to pay 6%? As a seller, I see I'm reading documents, it's 3%. Do I have to offer the other 3%? Why don't I offer 3%? And why don't my seller and my buyer split that 3%? Those are going to be a lot of the discussions that are going to happen more now because it's different, okay? And also, if I'm a buyer's agent right now, if I go to MLS, I'm not going to see my 3%. There's other ways to figure out, other websites to go to see what the seller will be offering as far as a commission to that buyer's agent. But it changes the landscape, right? It gets people to be more creative. They have to check different places. And as consumers become educated on this, the questions coming in on why does it have to be 6%? That starts to really ramp up that conversation. And it's going to be, especially, that's going to change the industry, I think, quite a bit. Now, if you're in the market right now, it's important to know this is expected to go in July of this year. So I would, it's going to be business as usual between now and July of this year. But if it does go into effect, it's going to be a lot more discussions kind of going forward.
Bill, let's talk about the data that we got out this morning. Danny just laying it out for us, saying that there's certainly a lot more optimism here for the spring selling season. When you look at the data that came through on housing starts for February, what are you seeing?
We're seeing that things are really kind of holding steady, like you said, in some markets. In some markets, it's really hot. I think you're going to have a strong spring selling season. I think it might not be as good as it was when mortgage rates were way lower and things were kind of gangbusters, but I think that you're going to see a very strong spring selling season. I'll just mention one thing. I think that your colleague was absolutely right. It depends on which market you're in. If you're in some of these markets where there's a lot of supply and stuff, you're not going to see the type of home price appreciation or kind of as strong of a spring selling season. On the other hand, if you're in Florida or if you're in some of these geographies that are doing very well, I think you're going to see a very competitive spring selling season. And I wouldn't be surprised to see people try to take market share. And the big builders, frankly, will probably do pretty well coming up into this spring selling season.
Finally, Jeff, when you look at where the market has been, yes, rates have been elevated. Yes, inventory has still been very much limited. And what you're seeing increasingly are those who are in the market, are those who are existing homeowners. When you think about where the conditions are today, where they're likely to move in the next several months, where does that leave first-time home buyers who have had such a hard time getting in?
I think where the first-time home buyer is actually, I think it's starting to be slightly better. And what I mean by that is last year right now we have about 1.66 new homes and apartments being built currently under construction. Guys, if you think back a decade ago, we lost around 6 million units coming to market for various different reasons. So I think, and again, depending on where you are, I happen to be here in Florida where things are incredibly tight. There is more inventory coming to the market. You look at Pulte, you look at Lennar, the big home builders are really putting a lot into the market. So at a 7% interest rate right now, that's still, probably higher than historically has been. But if you look at the MBA and what they're projecting, they're saying it's going to get down to around 6.6%, hopefully over the course of the next 3 to 4 months. That should help affordability a little bit, coupled with 1.66 million houses under construction. If somebody wants to sell their existing house and that end goal is to get into a new house, that's a better point in time to do this now than it has been for the previous 5 years. So I think overall the housing market's incredibly strong. I think price appreciation will stay sort of flat to rising over the course of the next year. And if everybody is right, and we do see some Fed rate cuts on the second half of this year, you could see even a stronger spring/fall home buying season.
Bill Pulte, Pulte Capital CEO, and Jeff Taylor, Emphasis Digital Risk founder and Mortgage Bankers Association board member. It's good to have both of you on today. Really appreciate the perspective.
Thank you.
Coming up on the other side, we're going to dig into the EV space, what names you should be focusing on in this shifting space. That's coming up after the break. Well, Shell out with an announcement that it will be transitioning to improve its place in the EV market and shrinking its retail footprint. Let's bring in Yahoo Finance's Pras Subramanian to give us the details. So, Pras, are we talking about basically using the Shell footprint, swapping out the pumps for chargers? Or are we talking about shutting down those stations altogether?
Well, hey, Kiko, they want to shut down around 500 Shell locations in 2024 and 2025 over the next 2 years, so 1,000 locations there. But the thinking here is they kind of want to optimize how they roll out their EV charger. They call it the Shell Recharge product. They see a big business for that, especially in China and in Europe where demand is higher. They want to expand that to, I think, around 200,000 chargers. So the deal here is that yes, they're going to divest some properties here, but they're also going to possibly expand with more charger plugs at current locations, close those lower performing gas stations or filling stations, add more chargers at mobility hubs, like things like supermarkets and coffee shops. And they may just install more chargers, Kiko, right, at the current gas filling stations they have. I mean, they have 47,000 locations currently, so closing 1,000 is about 2%, so not that much, but that's still 1,000 stations that are gone.
Pras, what does that tell you about where Shell sees its place long term? All this talk about slowing growth in EV sales, slowing adoption rates, and yet you still got companies who are saying, look, even though that's the story right now, 10 years, 20 years down the line, the adoption, that transition to EVs is still very much intact.
Yeah, it's not just Shell too. BP also getting involved in the charger game too. But I think what they're seeing is that they need to put these chargers in really high traffic areas, also areas where fleets will use them, because if there's too much downtime, it's not worth their trouble to invest hundreds of thousands of dollars at each location to build these DC fast chargers in some case. But I think they also see the fact that if you have things like coffee shops and small retail shopping and other things that people can do at these locations while they charge, it makes a lot of sense. Again, the less downtime, the better for them. And I think that they believe that the way that their footprint exists now globally, especially in Europe and China, they can actually make money on the business. And they're looking at a 12% sort of rate of return on this business down the line.
Yeah, it's going to be interesting to see what kind of experiences pop up on the back of these charging stations. Pras Subramanian, thanks so much for that.
Thanks.
Well, we are watching shares of Hertz closely this morning after news that its CEO will resign after a failed attempt into EVs. That stock up about 1% right now. This follows an announcement back in January where the car retail company said it would sell 1/3 of its fleet on low demand and increasing costs. All of this, of course, coming against the backdrop of EV adoption rates slowing, although there is still growth, and Western EV makers facing increasing competition from Chinese players. Let's bring in Greg Migliori, Autoblog editor-in-chief, to discuss more. Greg, good to talk to you today. There's been so much news here within the EV space that seems to point to a bit of a doom and gloom. Adoption rates aren't as rapid as they were several years ago. We were just talking about Fisker the other day and how they are pausing production because of a cash crunch. What's the overall trend point to?
So right now, I think we're in a state of where it's like the late stage early adopters. So a lot of the folks who were really interested in EVs, they already have them. So now you're at that point where you're somewhere in that delta between, hey, when's the mainstream general public going to really get and understand and use EVs? And all the people who essentially were really the first ones to get it, they already have them. So that's a challenging spot to be. And of course, infrastructure remains a great challenge. Just the news you were talking about with Shell and of course with BP, that's going to help dramatically, because one of the biggest challenges EV owners and users face is it's a bit of a different experience simply to power up your car. You have to seek out the charger. You have to make sure the charger might be working. If it doesn't work, you have to go someplace else. All of that adds complexity to what is already a technology that is a little bit different for a lot of folks.
Greg, what we have learned over the course of the last 6 months even is that you got big players like a GM or a Ford that can afford to be able to pull different levers. GM getting into more hybrids as a result of what they're seeing in the market. And then you've got the upstarts like a Fisker, like a Rivian, like a Lucid, who don't have that kind of flexibility. So if we're talking about a bit of a lull until the next wave begins, Where does that leave those upstarts?
So the upstarts historically have always been in kind of a dangerous position. I almost hate to say that, but you see that where they don't have as much of a room of a margin for error. Fisker is talking about partnering with Nissan. We've heard some news in the last couple of weeks that Fisker's finances perhaps aren't where they need to be. And upstarts always face those challenges. Rivian is a great example of revealing a couple of really interesting new products in the last couple of weeks, the R2 and the R3. They're going to be more affordable. They're amazing, looking as far as designs. Really, I think something that could give consumers something to think about. They also mentioned, hey, they're not going to build these at a factory in Georgia. They're going to consolidate their manufacturing operations in Illinois. That's good business sense, but it also is a situation where the company is being mindful that having multiple factories, having these large footprints might be a bit too ambitious. I'm pretty optimistic for a company like Rivian. As far as Fisker, Fisker has always been great as far as design. I remember there was a Fisker about 10, 15 years ago, and this is at least the second iteration of Fisker. They appear to have less staying power, but we'll see.
Greg, does this open up or at least increase the possibility of M&A? I mean, you've already talked about potential for Nissan and Fisker, some kind of partnership there. What about Rivian? What about Lucid?
Well, it's always a natural situation where you have these smaller companies like Lucid, like Rivian, like Fisker that have one or two compelling products, something that maybe a larger automaker, Volkswagen, General Motors, Honda, might want to get that product. So I think they're always vulnerable to, being picked off, but there's also, that's challenging in and of itself, because if you say somebody were to buy Fisker, you have to deal with all the challenges that then comes with managing a smaller company that perhaps isn't as well integrated into your culture as, like an existing, just standing up an existing entity. So there's challenges in that sense as well. I think a lot of these companies are very good at developing interesting products, vehicles that are fun to drive. They look great. They have the range. They have the batteries. But then when it comes to mass production, selling them and reaching like a new market that will grow their company, that's where the challenge comes in. Lucid is a great example of a company that makes a very compelling product. They're well funded, of course, but they're also very expensive vehicles. So I kind of doubt a company like Lucid will ever be truly mainstream.
Greg, the expectation is this second wave of adopters are going to be a lot more price conscious. You mentioned infrastructure a concern, but price still very much high. When you talk about these brands that you just mentioned, as they look to offer more affordable vehicles, you've got the Chinese players like a BYD selling cars that are $10,000, maybe a little less in China. Even if you have the tariffs, you're still talking about a very aggressive price strategy. Does that leave a lot of these Western car makers particularly vulnerable when they don't have a low-cost offering right now?
That's always going to be tricky. I don't think there's sort of an immediate, danger, if you will, of the U.S. market being flooded with, products from overseas manufacturers, particularly from China. The U.S. market in particular has a high cost of entry, a high barrier of entry for automakers. It always has. Americans like their cars large. They like them well equipped. It's a highly regulated market. It's not an easy thing to do. I saw a BYD vehicle at the Detroit Auto Show in 2008, 2010, and they're still not here. So I think that's a little bit of it's a business, it's a product situation that in some ways has actually gotten to be political. I think where you're going to see U.S. and European automakers compete with China is in other overseas markets, perhaps in India, perhaps in China itself, in South America. And that's where it's going to be tricky to see how American automakers and other Western automakers can get that cost down to compete with, a $10,000 BYD car that has great range and looks interesting. That will be a big challenge for Western automakers.
Okay, we'll be watching that head-to-head play out. Greg Migliore, Autoblog Editor-in-Chief. Good to talk to you today. Appreciate the time.
Thank you.
Well, coming up, more coverage from CERAWeek. We're going to bring you Julie Hyman's conversation with Chevron's VP of Carbon Capture, Utilization and Storage. That is up on the other side of the break. We'll be right back.
Yahoo Finance's Wealth is your guide, your group of advisors, planners, and jargon busters to help you save, build, and grow your money. How do I know if I'm saving enough for retirement? How do I know if it's right for me to go on that lavish vacation? Is it finally time to refinance my mortgage? How do I pay less in taxes? We'll get you the answers you need. Wealth, earning it, growing it, and managing it. It's more than tracking just the latest market moves. It's more than your favorite trending tickers. One does not simply build wealth without considering the entire financial landscape. It takes a community, and we've built one for you. Wealth cuts through the noise to help guide your financial decisions so that your money works for you. Wealth on Yahoo Finance premieres March 25th.
You're watching Yahoo Finance. I'm Julie Hyman at the CERAWeek by S&P Global Conference in Houston, Texas. As we've been talking about, a big topic here is energy transition. And for the energy industry, a big part of that is carbon capture. So our next guest is squarely within that area. He's Chris Powers. He's the Vice President of Carbon Capture, Utilization, and Storage at Chevron. And thank you so much for being here, Chris.
Thanks, Julia. I appreciate it.
So a lot of folks aren't necessarily familiar with what we call CCUS, which is the acronym for what we just talked about. So when we talk about carbon capture, it's effectively pulling carbon dioxide either out of the air or out of the processes that make refined products, or how you get oil and gas out of the ground. And you store it, you bury it in the ground, you try and capture it in a way that it then doesn't add to the atmosphere. Do I have that right? How exactly?
You've nailed it.
Okay.
So I think about it as a couple of key steps in the process. Simply put, CO2 is produced by nearly all the operations that give us the quality of life that we have today, whether it's producing power, electricity, whether it's producing cement, steel, oil and gas. You emit CO2 as part of these processes. And with the CCUS business, what we're hoping to do is capture the CO2 either before it's released into the atmosphere, or, as you pointed out, take it out of the atmosphere through direct air capture. You then compress it, dehydrate it, put it in a pipeline, and move it to a site that has suitable storage deep underground. Then you inject it in the ground through a wellbore, just like you do in the part of the traditional business, and you'll store it a couple miles underground for geologic time.
Now, this whole endeavor has gotten a little bit of a shot in the arm from the Inflation Reduction Act on the part of the Biden administration, and just also a general move towards carbon credits over the past, let's call it 5 to 10 years. So where is Chevron in this process, and what kinds of projects are you all working on?
Yeah, we're taking a global look at the CCUS opportunity, right? So we're focused squarely, though, in the U.S. The IRA has driven a lot of capital into foundational projects in the U.S., but also across the Asia-Pacific region. So Australia is an area that's very prospective, and we have some projects that are announced there. In the U.S., though, our main project is at Bayou Bend, which is in Southeast Texas, only about 50 miles to the east of Houston as well. So what we're looking to do is to find geology that looks very suitable and amenable to store the CO2. We then perform seismic analysis to identify the zones of interest. We'll then drill delineation wells, or we call them appraisal wells, to understand the exact rock properties. We'll then build out our reservoir models, and then you submit your permits to the EPA to receive your Class 6 permits, and then that can kick off your project.
So I was reading a little bit about one of your projects off the coast of Australia, the Gorgon project, which is a liquefied natural gas project where you're trying to capture some of the CO2. But it sounds like it's really, in some cases, challenging to do, and especially challenging to do economically, not just actually physically. So, and each of these projects is sort of unique, right? So how do you do it? How do you scale it? And how do you make money off of it at some point down the line?
Yeah, well, it's early days for all of these energy transition businesses. I think that's the foundational thing to start with, right? So we're working on doing foundational projects that can build the foundations of a business that can grow and scale over time. And you got to remember, what we're really trying to do here is to enable decarbonization for many of these industries, which are critical to everyday life. So we've learned a lot at Gorgon, and I think it's actually made us more optimistic about CCUS than it has less. Each reservoir is a bit unique, and so what we've applied the learnings from Gorgon to look at areas around the globe that are going to have the most prospective geology, where we can have the most simple and predictable operations, and that's what's made an area like the U.S. Gulf Coast look very favorable, because it has the same type of sands that have produced oil and gas for the last 100 years. The same type of deposits are very amenable for CO2 sequestration. So we've done a broad swath and canvassing of geology around the globe. We've identified the areas of interest, and we've secured pore space in those and are hoping to bring projects forward.
Do we know how long the CO2 will stay captured in these areas? Because this is a relatively new thing that we're doing.
Yeah, so we're focused primarily on permanent sequestration. Some other companies are focused on enhanced oil recovery. That's not been an area of focus for Chevron. But with the permanent sequestration, the CO2 is stored.
Permanent. It's never getting out.
Yeah, and there's a number of different, on the rock property, interstitial levels, there's a number of different physical mechanisms that cause the CO2 to stay there, but ultimately you inject it. You have monitoring wells that monitor how the CO2 progresses through the rock strata over time, and then you will terminate the injection at some point 10, 20 years down the road. You continue to monitor until the CO2 plume stabilizes, and then at that point, that project is finished. and it's the CO2 is stored for geologic time.
Now, Chris, I want to ask you this. What role this business plays for Chevron? And I mean, a lot of the other big companies here are doing similar businesses, if not exactly the same. And so I guess I'm curious, as we hear more rhetoric about that we are not seeing a sunsetting of oil and gas, where there's still demand for oil and gas. So in that case, what role do these technologies play in your business? And at some point, will we see more of a decrease in demand for oil and gas, and these businesses will be a much more important proportion of Chevron's overall business?
A few things to unpack there, Julia. I appreciate the question.
Sorry,
so first,
I know there was a lot of
No,
that.
that's great. So in terms of, I'll break your question down piecemeal. We're focused on both lowering the carbon intensity of our own operations as well as building third-party facing businesses to help enable the harder to abate sectors like cement, steel, and power to decrease their emissions over time. So we're tackling both of those pieces of the transition. In terms of the growth, right? It's going to take decades. These businesses are capital intensive. And you're going to need to invest capital nowadays to grow businesses that are going to be in operation for decades to come. So it's going to be a slow build, but we're optimistic that over time these businesses will play a bigger and bigger role in the energy space. On the terms of the supply stack, we're a firm believer that all forms of energy are going to be required. There's 2 billion people that still want to increase their standard of living around the world. They live in some level of energy poverty, and you're going to need solar, you're going to need wind, you're going to need nuclear, but you're also going to continue to need oil and natural gas. You're going to need hydrogen. You're going to need CCUS. So if we take a Big Ten approach and support all forms of energy, I think we're going to be able to deliver the affordable, reliable, and ever cleaner energy that the world needs.
And just very quickly, CCUS, do you have an estimate at Chevron of when it could be profitable, or is it still too early even to say?
It's very early days for these businesses. The 45Q credits through the IRA, I view those as a foundational enabler to get these businesses moving. And if you think about it, it's not really that much different than what some of the other industries, solar and wind, they also had policy enablement to get started, and then the businesses grow and scale over time, cost curves come down, and then the businesses can grow into a market.
Chris Powers, thanks so much. Appreciate it.
Thank you very much. Appreciate it.
We'll have much more on Yahoo Finance right after this.
AstraZeneca announcing it will purchase Canadian drug developer Fusion Pharmaceuticals in a $2 billion cash deal. Let's bring in Yahoo Finance's Anjali Kamlani, who's following this deal news for us. Anjali, to what extent does this expand the portfolio for AstraZeneca?
It definitely is an additive for the company. They're really looking to grow in oncology right now. So this deal is $2 billion acquisition for the company Fusion, which is already a partner of the company. They've already been working together for about 3 years. And so Fusion really adds a different type of oncology pipeline for the company. If you take a look at the relationship, we know that the Canadian-based company also gives AstraZeneca growth in the Canada space. So that's sort of where this adds to what AstraZeneca already has, which is those antibody drug conjugates. And this is one aspect of it. Fusion also has a couple other platforms as well to bring under the roof. AstraZeneca has really been chasing oncology for a bit. They currently have 40% revenue as of 2023. That's an increase of 21% coming from oncology itself. And so while it hasn't necessarily been a leader in the past, the company did say at the JPM conference earlier this year that it's driving towards becoming a leader in the space by 2030. So this just adds to what the company is looking at. Currently, it does have a little bit more of a focus on breast cancer and has other types of platforms that it's focused on. But these ADCs really a big deal in the oncology space right now. So this gets it going further in that area.
And the stock getting a huge bump on the back of that Fusion Pharmaceuticals there. Anjali Kamlani, thanks so much for that. Let's do a final check of the markets before we let you go. We go into the noon hour here, looking at a bit of a split picture, kind of a quiet trading day. You could argue the Dow up, although the Dow up 213 points, the S&P 500 up roughly 1, and the Nasdaq down 55. Of course, investors keeping a close watch on what's playing out in D.C. with that FOMC policy meeting kicking off with some decision expected tomorrow, although not a huge policy change expected on that front. And we've got all those bases covered for you with much more to come here on Yahoo Finance. Keep it right here.